capital markets. And Dietrich, Ryan, great to have you here with us this morning. All right, first and foremost, we just got to get your perspective on what we've been discussing more broadly here in the Fed and its comfortability in kind of spurring a recession, and how deep, long, or protracted do you believe that recession could be?
You guys want to start off with something a little easier? No, good morning. Thanks for having me. I mean, listen, I think the Fed is hinting that they'd be okay with a mild recession. And although we don't think we're in a recession right now, you don't have 3.5 million jobs created be in a recession, in our opinion. The truth is, again, things are clearly slowing. We all get that, right? So 9 months from now, we might be in a mild recession. You look at it, though, historically, the Fed hikes until the Fed's funds rate's above CPI. Right now, that's 3.25 versus 8.3. So there's still some room there. We still think inflation is going to come down fairly quickly. I know we had that sticky CPI number, but producer levels, prices paid, chicken wings. There are some things really coming down on the inflation front. But the truth, again, the Fed's seen the history books. Maybe last comment. The Fed's seen the history books, right? It took a double dip recession in the early 80s to stop that runaway inflation. We don't think we're going to necessarily need that, but they know you might need something besides just hiking rates, and that could be drastically slowing the economy, maybe to a mild recession, and that could be kind of what stops inflation. And honestly, guys, the stock market's pricing in a mild recession as we speak, down 24%, maybe making new lows for the year on the S&P as we speak today. That's pricing in at least a mild recession. So from an investments point of view, there are potentially some positives.
Ryan, thanks for the hot tip on chicken wings. Though, I may not be able to open a home, but I'm going to go buy those in low and just store them in my freezer in my plate, because that makes a lot of sense to me. But look, I'll push back on this. I think this market is starting to now price in more than a mild recession. We are looking at potential testing of the June 16th lows on the S&P 500 around 36, let's say 3,600, and then the floodgates open after that. You can see the S&P go below 3,300. Is that a reasonable scenario if we start getting some really bad economic data?
If we start getting really bad economic data, it's possible. And let's not forget, 3,500 is actually a 50% retracement of the entire bull market. So that's a really big kind of number to be aware of, 3,500. But again, you just talked about it, Brian. Like, it's pricing in some bad stuff, right? Look at that AAII sentiment poll. I know you guys talked about it. More than 60% bears last week. Only 4 times in history. All right, near major market lows, like every time that's happened. So again, everyone's thinking all this bad stuff's out there, and trust me, we're aware it is. When you look at bonds down 14% for the year and stocks in a bear market, this is like the worst year for a 60-40 portfolio. Only once was it worse, in 2008, when stocks dropped 40%. So it's a terrible year for investors. At the same time, so much bad stuff is being priced in. When you look at all these sentiment polls and things, I would like to see the VIX a little higher. I would like to see put the call ratios a little bit higher. But again, last comment, October's a bear market killer, right? 84, 94, 98, 2011. For whatever reason, October tends to be a bear market killer. We'd just be open to the idea that could be happening potentially once again this October, with a tad more weakness. And then, that seasonal strength around a midterm election into the third year of a presidential cycle, especially under a first-term president. That third year usually does really well. I think, investors should be thinking about that at least.
Is a defensive portfolio the only play right now? Is there some other type of strategy that investors can employ?
Yeah, well, good point. I mean, with stocks down this much, we think, a little defensive, your utilities and staples, but honestly, start looking at some of those cyclical areas, right? Your financials and industrials. I mean, I know they're down a lot and they've underperformed, but honestly, financials or industrials are starting to do a little bit better. So we think kind of that barbelled approach right here for an investor makes sense, because if you all in defensive right now, it's what everybody else is kind of doing. And again, look what happened last week, right? Energy's been doing awesome. Energy was down 9% last week, right? I think one of the things you need for a major low is to shoot everybody. And honestly, now that they're shooting energy and some of the previous leaders, that could be a good thing to finally make some type of a major market low here.
At what point, Ryan, do you jump in and buy big cap tech? I mentioned Apple at the top of the show. It is now leading this market low. Microsoft down over 11% in the past month. Apple down 9%. These are huge declines in household names of companies that are still showing double-digit sales and profit growth, impressive cash positions. Is now the time to jump in, even under the assumption that maybe we lose another 5% here?
Mm-hmm. Yeah, I'll tell you what, Brian, we don't really like large cap tech here. We're still underweight that group. We think some other areas, we like small caps, actually. I mean, we think small caps could do a little better than large caps going forward. At the same time, for somebody who's looking at a 1 to 2 to even longer term horizon, there are some incredible companies you just kind of talked about there, making a lot of money that aren't going anywhere, that again, if everybody's thinking alike, somebody isn't thinking. That's the quote I like to use a lot from Patton. A lot of people don't want to touch anything here. So maybe there's some opportunity, and some of those could still do fairly well longer term. We're not too warm and fuzzy tech in general here, honestly, still.
Carson Group Chief Market Strategist Ryan Dietrich. Ryan, always a pleasure to get some of your insights, especially kicking off a new trading week here. Thanks.
Thanks, guys.
Dallas Cowboys owner Jerry Jones has taken his investment strategies outside of the world of football, seeing a more than 300% return on his now 182.2 shares of natural gas producer Comstock Resources since 2018. Jerry Jones and Comstock Chairman and CEO Jay Allison join us now live from the New York Stock Exchange. Yahoo Finance's Josh Schaefer is also with us. Good morning to you both. Jerry, I'll start with you. Why did you make this investment in 2018, and how confident are you in the outlook for the company moving forward?
Well, I deliberately went to where the gas was, the Haynesville gas. Comstock had drilled more Haynesville gas wells than anyone. They had initiated the play when it first started years earlier. But it was an opportunity in my mind to get involved with the ability to export natural gas liquids, LNG, the ability to do that. Then I wanted to saddle up with the people that knew it the best in the Haynesville. I made an investment that initially of about $600 million, and then I came in behind that with an investment of about $475 million. The more I found out about Comstock, the more I wanted to put in it.
Jay, it's been a good year in the energy sector. I mean, it's been the best outperforming sector at this point in time. And so even as you think about the gains that the share price may have seen, how do you think about the future moving forward from here, and where you may have to continue to invest in order to grow out the business even further?
Well, I'll speak as an investor. The Comstock can differentiate itself from the idea of a energy company. Comstock has very unique reserves. They are, the acreage is where the ethos of the people that do the work, they're generational in being in the oil and gas business. The laws let you put in pipelines, and they let you take it a short distance to the Gulf where you want the gas to be. And so we have a huge butane tank, if you will, of supplies that frankly, in and of itself, could knock a big dent in what you're selling, what Germany needs. It's that kind of size. So I'm excited about where we are in this current time of investors looking at a natural gas company, where its place is in the energy world, and I'm excited about our management team we have at Comstock.
Jay, you've spent a lot of time in this industry, and we still might see economic growth slow into the winter season. Perhaps we might already be in a recession. Who knows? What does that mean for the outlook for natural gas prices?
Well, I'm not going to get into, because I don't go there, really in analyzing seasonal trends. I will say this, that we all understand that weather and climate help influence gas prices, and we understand aberrations, catastrophes, those kinds of things. But I look at this long term. These reserves that Comstock has can make it go at $2 gas. We can make it go at the different ranges of whatever gas is. It will, though, be there without debt, without loading the company down with debt, so that we will be able to manage through low prices so that you can basically be viable and have the gas for the complete spectrum of demand. Gas is about delivery, not about reserves. It's about delivery. And Comstock is in the place to take huge reserves and get it delivered to the market at the lowest cost in the industry. That's why I'm here.
You know, when Jerry called, he asked if we drill a well, can we take it to sales? And if LNG has legs, can we deliver it to the LNG shippers? And then, do we have inventory? I think the one thing that the M&A world is doing, they had to really grow, even recently, because they had a lack of inventory. If you look at what Jerry did in 2018, he consolidated his private company into Comstock, and then we were aggressive in M&A in 2019. That's when gas was $2 and $3. To be aggressive in M&A when gas is $6, $7, $8, $9, we think goes against our plan. So what we have today, we've got the lowest cost producer with the highest margins, with we think the greatest inventory. We drill about 80 wells a year. We turn about 58 of those to sales every year. So we have about 25 years worth of inventory. So it's pristine, and the cost structure is extremely low. I think we got the lowest G&A in the whole sector. And if you just look at sheer cost, you know, it takes us $1 to run the company, and our historic finding cost for 3 years, our numbers, is about $1 to find and develop these reserves. So anything over $2 is a profit for Comstock. Our EBITDAX margins, if you compare them to other oil companies and or gas companies, they're 85%. I mean, these are the highest of the high. So that's what we have, and you know, gas prices will fluctuate, but I do see natural gas, it's taken a detour from where oil is, and it's probably trading at a 10-to-1 now ratio. So it's important. I think it'll be important in the future. They predict by 2023 that the demand for natural gas will probably be greater than oil. So we'll see. As Jerry said, we're sitting on some tremendous gas reserves, and most of that is held by production. 85% of what we own, we do not have to drill. So you put a rig or two out there if things get really tough, and we're still in tremendous shape, particularly
Well,
the
and
balance
Jay,
sheet.
I want to interrupt you because he and 2 or 3 other of his management team just bought $5 million worth of stock in the last few days. Now, of course, I sit here as someone who's put over $1 billion in the stock in this company. I've always believed put your money where your mouth is. And what you're seeing is the people that are in the weeds, the people that are seeing the future both on a microscopic level as well as a broad picture are putting their money into Comstock.
So,
Well,
Jerry,
to Jerry's point,
just to jump in very quickly, Jay.
$5 or $6.
Yeah.
Yes.
Just to jump in very quickly, Jay, I just wanted to follow up on what Jerry just said. Jerry, would you be willing to take more of a stake in Comstock than you already have? And what threshold would that look like to you?
Absolutely. I have been ready to buy more of Comstock since the day I got here. We manage that way if necessary. What's ended up happening, though, is that we have delevered our balance sheet, and because of the gas prices, and we are sitting here today internally. And so we really can develop these reserves. We can figuratively double our gas production and do it all internally. We don't have to go do issue stock. We don't have to go borrow a lot of money. We can do it internally, and that's what makes Comstock so special.
And Jerry, we
Well,
can't
and I
have you
think
here
to my
without
point,
asking.
we were.
Sorry, Jay. I was going to cut in and
Excuse
ask
me?
Jerry a little bit about football here. I wanted to ask you a little bit about the Cowboys.
Football.
We know you're here in New York because you got the Giants game tonight as well. The Cowboys are playing the Giants. That game's going to be on ESPN, of course, Monday Night Football. But there has been a lot of talk about what Amazon's doing with Thursday Night Football. I'm curious just what you make of Amazon's interest in the NFL, and what does that mean for the NFL as a whole to have these big tech giants that now want to come and get involved with you guys with Amazon and maybe even potentially Apple down the road?
Well, I think Thursday night's audience was epic. Frankly, deserves special notice by a lot of factions. Those numbers were surprising to me, and I think they're a picture of what's to come. I don't believe there's any question that the game has the interest and has the eyeballs. We're at the right time of the year when you want the decision makers in front of the screens in the fourth quarter. I think all of that's alive and well. Frankly, the picture for the National Football League in the entire time I've been associated with it has never been better because of the continued interest. And then again, you look at last night. Look at how these games turned out last night. 6 or 7 of them decided just with minute to go or with a point difference, that type of thing. All of this points to real eyeball interest, and that's a big deal for the NFL.
And Jerry, you say the picture's never been better, right? We've talked a lot about valuations on this program as teams have been sold. The Broncos were sold for $4.5 billion. I know your valuation, according to Forbes, has basically doubled in the last 5 years at about $8 billion now. I mean, what do you make of valuations? Do you think those numbers are the right numbers? Do you think they're going to keep going up? Do you think the Cowboys are worth more than $8 billion anyway?
Well, I know that I wouldn't sell the Cowboys for 10. That is, I'll book it. I would not. Of course, I'm not interested in selling the Cowboys. And therein lies a part of the answer. You have limited owners. You have limited teams that might ever be available. And you have outstanding growth in those franchises. And then you have the fact that I bought the Cowboys not to make money at all. I had a little money. I'd done it in the gas business. I had a little money, but what I wanted to do was coach football. I never thought that I could be involved in something that would have economic viability. The fact that it does have economic viability and has for the last 30 years, beyond anything I could have ever imagined, is just a major plus. So I think there is future of values that will exceed what Denver went for sure.
Is there another big player you'd like to add to the team, Jerry? I asked this from a Philadelphia Eagles fan perspective. I just want to sense a landscape of the competition out there.
Well, I'm impressed with the Eagles team, period. And
Thank you,
I love
Jerry.
the way I love the way the quarterback has evolved. And I'll tell you this right now, this is really going to seem funny to you. I actually like Eagle fans because they are so passionate, they're so mad at it, and it just tickles me to death to be involved with them up there. And they're all frauds because they're pretty good people behind that hate that they have when they get on the football field.
I had to bring some of that Eagles energy to New York. That's why I moved up here, Jerry. Great to see you up here in New York as well at the New York Stock Exchange. I know you'll probably be at the game later on today, too, between the Cowboys and the Giants. Also, thanks to Jay Allison, Comstock Chairman and CEO, alongside Yahoo Finance's Josh Schaefer. Appreciate the conversation this morning.
With week 3 of the NFL season all but in the books, let's bring in Needham Company Managing Director Bernie McTernan to break down the betting landscape thus far into the football season. Also with us is Yahoo Finance's Josh Schaefer. Bernie, a lot of some big upsets over the weekend. A lot of people maybe counting their losses.
Yeah. Well, so we estimate that was probably a normal hold for the sports books this past weekend. Wasn't necessarily great for my wallet, but yeah, with the Bills, with two of the most like team, the Bills and the Chiefs going down. But overall, we think it was a normal hold for the sports book. The other thing that's hitting as well too is the unders. That's been hitting at a higher than 60% rate, actually pretty similar to last year. But what we focus on and what we think matters the most are the 5 highest spreads. And back to week 1, over the first 3 weeks, the favorite has won 3 or 4 of those, depending on the week. And so that generally points to a normal hold for the operators. So that's in line with DraftKings guidance. And then if we look at a company like Genius Sports, it's actually ahead of or better what they expected. They assumed a hold similar to last year, which was a headwind for the industry. Genius, as you guys have been talking about, is dealing with FX headwinds, but at least the game outcomes are better than what's contemplated in their guidance.
And as far as other numbers that you're looking at is where gamblers are going, right? What platforms they're using. I know you pointed out in your most recent note that DraftKings have been the most popular app on iOS. I was curious if that was surprising at all compared to maybe FanDuel, which I think we understand has more market share nationwide. Is it surprising at all to see DraftKings there? What do you think's driving that?
Yeah, no, it's pretty consistent with last year. If you look at the iOS App Store, DraftKings and FanDuel are really in that top tier together, really jockeying for that 1 and 2 spot for the top sportsbooks app in the sportsbook section of the App Store. And then MGM is really in the 3rd category, and that's followed by Barstool and Caesars below it. And that really held true for most of last year too. The one difference was when New York launched and Caesars made a big marketing promotion to really try to take share in New York. Caesars actually went up to the #1 app, but that was short-lived. If you look at after the NFL season and the NFL preseason, they went back to that number 4 or 5 range where they are currently. So it really seems to be shaping up the way it was last year. And that's a big investor question we get, is what the long-term market share of this industry looks like. And we continue to think DraftKings, one of the reasons why we have a buy rating on the stock is that we think that just their scale begets better technology, which could be a differentiating factor and a reason why customers keep returning to the platform.
And when we talk about the stocks themselves, we like to talk about spending, right? And the promotions that these different companies are kind of putting out there. Is DraftKings promoting more than, say, a FanDuel? How are you evaluating the promotions through the first couple weeks? And who's maybe promoting the most, and how's that kind of driving the market share? Yeah,
look, it's a great question. We have $800 million of an EBITDA loss this year for DraftKings, that peaking in the 3rd quarter with over a $300 million loss. And a lot of that spending is going on sales and marketing. In general, the promotional environment seems a little bit less intense than last year, especially because the Caesars, what I spoke about before, how they were really intense with the New York launch and then faded back. Really, but DraftKings and FanDuel, they've been saying that they're going to keep spending against their thresholds. So with DraftKings, that's a 2 to 3 year customer payback on gross margin. And they, both of those companies haven't backed away in terms of how much they think they're willing to spend. DraftKings thinks they have enough cash on their balance sheet to be investing and acquire customers in the same manner they are now to eventually get to profitability in 4Q of 23. And we think full year profitability in fiscal 24. So no real change from the top two. It's just more Caesars. I think we're seeing them back off a little bit relative to the peaks of last year.
Finally, Bernie, from an investment standpoint, where do you see the biggest upside? I mean, which one of these companies offer the most value for the price it's trading at?
Yeah, I mean, frankly, there's 3 companies that we like that we have buy ratings on that I would suggest here: DraftKings, Penn, and Genius Sports. On DraftKings, it's really for the investor that's willing and able to take that 2 to 3 year time horizon, when you're able to look at 25, 26 EBITDA, put a multiple on it, discount it back. With Penn, they're generating profitability now. They have the core regional casino business, but even their interactive segment, it's only going to be a $50 million drag this year. The core US is going to be at least break even. And we think that that's a unique opportunity to play this space and really leveraging that convergence between sports betting and sports media. And then lastly, I mentioned earlier with Genius Sports as the data provider. And really they're using their data contracts to create other businesses. So if you're watching Prime Video on Thursday night, and you'll see that Prime Cast, the alternative broadcast, well, a lot of that is powered by Genius Technology. They also have a ad serving capability where they're helping sportsbooks acquire customers. So really leveraging that data relationship with the leagues and the sportsbooks to create a whole nother or other revenue streams about it. So those are 3 picks that I would highlight in the sports betting landscape that we're bullish on.
Well, Bernie here's hoping for a better week 4, maybe for your wallet. Bernie McTernan, Needham Company Managing Director. Always good to have you on the show. Well, if your summer utility bill sends a shock through your wallet, you may want to brace yourself for more high prices come winter. Some estimate households could be paying up to 25% more to heat their homes this year. Joining us now is John Bartlett. He's president of Reeves Asset Management. John, it's good to talk to you today. We just said 25%. I've seen some estimates that put it at about 35%. How painful are things about to get?
Well, I think we're going to see the worst of it this winter. That's the good news. It is. It really depends on where you live and how you heat your house and how your utility generates its electricity or buys it on your behalf.
And John, talk to us a little bit about the impact of natural gas on utility companies today.
Sure. Well, you know, natural gas is the fuel that sets the price of electricity. The last generator that comes on is usually a natural gas facility, and that's the one that sets the price. Generally speaking, your utility is buying natural gas either to fire its own generating stations, or it's buying natural gas for you to heat your house. They're buying it all year long, and when we get to the winter months, roughly half of the gas that you're burning in your house is coming out of storage, and that gas obviously was bought much earlier on in the injection season.
Yeah. So what's actually driving these prices to these levels? Is it a simple supply demand dynamic? Yeah.
Well, in this winter, it's just simply that, and it is something that is, you know, as you can imagine, the best thing for high prices is really high prices, and we're seeing that at work right now. That is the confluence of supply and demand really adjusting to a little bit better sense of equilibrium.
So how should investors play the utility space? Because I'm taking a look at our Wi-Fi Interactive board, our charts for the sectors. XLU is down more than 1%. Outperforming, though, the broader markets, as you're looking at the S&P down year to date, 22%. XLE, of course, is the major one that's gaining this year. But so how should investors play this? Do they continue with utility stocks if they're in these, or do they sell and take some profits off the table?
Well, you know, I think as far as utilities go and their relationship to the rest of the market, what you see is what you get. And what we've experienced this year is significant outperformance, really on the backs of the fear trade and also a fundamental improvement in the industry. And that's not insignificant. Generally speaking, if you kind of look at long periods of history, utilities tend to be fairly correlated with interest rates, but they also generally tend to do a little bit better than you might expect during periods of inflation. And that, coupled with really the backdrop of what's been very constructive regulation, not only at the state but also at the federal level, utilities have had a good run, and I think what you can expect is your dividend yield plus your earnings growth on an ongoing basis. There are some PEs that are probably a little too high, and there certainly aren't any places to go bottom fishing in utilities. But again, I would go back to my earlier comment. What you see is what you get: earnings plus dividend, and a very strong outlook.
I mean, is this sort of similar to what we've been seeing when oil and gas companies? I mean, oil companies, we're talking about natural gas here, but, we've seen the profits go up on the back of consumers who are the ones that are having to pick up the load. And yet it's been incredibly profitable and good for investors, too. I mean, is that sort of how investors should be looking at these utility names as we go into the winter months and look at these major price hikes?
No, I don't think so at all. All of those companies profit on higher commodity prices. Utilities really only have their fortunes based on solid regulation and the investments that they have in their companies. So if the price of natural gas goes up, it really is a pass-through from the utility to the customer. So it's an unfortunate situation for the customers. It also, no utility likes to see bills go up. A, because they don't have any benefit from it, but B, it's just not good for their relationship with their customer and their regulator. So, again, I don't think you have to worry about, whether or not the commodity is going to affect the profits of these companies. And you certainly shouldn't be investing in utilities to, say, go long natural gas or something like that. So it is, again, these are conservative investments. Plenty of stocks that yield, well over 3% have their earnings growth, in excess of 5%. So the opportunity for a, kind of high single digits total return is, plus or minus a little something from the stock market. Is very visible at this point.
Yeah, well, a lot of Americans bracing for some sticker shock come winter. John Bartlett, president of Reeves Asset Management, appreciate your time today. Well, the sterling has slumped to a record low against the dollar thanks to a combination of a soaring greenback and concerns over the UK's latest budget plans. Speculation has now been ramping up throughout the session that the Bank of England could step in with an emergency rate hike. The euro, by the way, also slumping to a fresh 20-year low today. This amid major political moves in Italy. The nation now has its first far-right government since World War II. Giorgia Meloni, leader of the Nationalist Brothers of Italy, leads the bloc. Joining us now to walk through all of the FX moves for us, Citi's head of European foreign exchange strategy, Vasilio Giannakis. Vasilio, where to start, right? Let's start with the British pound, because you made the call last week that you expected it to reach parity to the dollar. Certainly it feels like it's moving in that direction. What has been driving this kind of reaction in the market?
Well, for sure, there's definitely the element of dollar strength. But as far as sterling is concerned, it's clearly on the back of the UK fiscal announcements. I think the market is taking the view that the sizable tax cuts, the biggest tax cuts we had since half a century now, 1972, which are going to be financed by borrowing predominantly, are likely to be unsustainable. And basically what you're getting is an erosion of confidence to the UK economy. And that's why you see sterling plummeting. Obviously, there is a very high likelihood that the Bank of England may step in for an emergency, as you said, rate hike. I think, if and when that happens, I think will provide some stability. But I think by and large it's going to be very short term. I still stand by the view that sterling will have to depreciate further, basically to compensate investors for higher UK risk premium.
The timing of all this certainly raising a lot of questions. Obviously, the Truss government just starting things here, going bold, as some would argue, going for these kind of tax cuts. But also, you've got the UK dealing with record inflation, not unlike other countries, but the question about why, in fact, this is the time to be doing it. How does it complicate the outlook and the trajectory for the Bank of England as they move to rein in inflation?
Well, to your first question about the timing, I think by and large is based on what I consider to be a misconception. It's quite clear, we've heard it from the Chancellor, they're targeting 2.5% growth. But the idea, this notion that governments can actually target and deliver on that target has absolutely no empirical and no theoretical backing, basically. In terms of complicating the backdrop, it certainly complicates it a lot. First of all, you have an already high inflation. As a matter of fact, the UK is running the highest headline inflation relative to the rest of the G10 economies. And secondly, it will be happening in parallel to the initiation of quantitative tightening by the Bank of England. So basically, you're going to have the Bank of England gradually offloading its stock of government bond purchases in parallel to the Treasury flooding the market with yields.
Vasilios, the moves in the U.S. dollar against other currencies has just been parabolic. I'm going to pull up our Yahoo Finance chart, and you can see the U.S. dollar index is against a basket of currencies year to date up 18%. You've got the U.S. dollar against the Japanese yen up 25%. How sustainable are these moves, and what will it take to cool off the U.S. dollar?
Well, first of all, purely from a valuation perspective, I have little doubt that the dollar is very much overvalued. But that being said, historically, what we find from an empirical perspective is that the two things, when they happen together, tend to be the most favorable environment for the dollar, and that is the Fed hiking rates and at the same time global growth. And this is pretty much exactly what we had so far this year. And I have to say, this is what we're looking to get over the foreseeable future. It's pretty clear the Fed is in very bullish stance, unconditional commitment to tame on inflation, even if that means demand destruction. So further rate hikes, yields, final real yields will go higher in the US. And equally at the same time, we're operating in an environment of very sluggish growth with no prospect actually of coming out in sustainable basis anytime soon. And it's important to watch. The stimulus has been half-hearted and therefore not enough to bail out global growth.
Finally, the other central bank we've been watching closely, the Bank of Japan, we should point out the only major bank that still has a negative interest rate policy in place. We've been talking about the strong dollar really driving the yen despite the intervention that we saw from the BOJ last week. You know, the argument for a very long time, at least in relation to what's been playing out in Japan, is that a lot of the risk is contained because so much of the debt is held domestically. When you think about the huge swings that we've seen in the currency and where the BOJ is moving, does that argument still hold?
Well, look, I think there is a validity to that. One could equally say that if we were the possibility of significant debt being held by that would have resulted in a much stronger rally in dollar yen. But I think the fundamental driver for this year's dollar yen significant depreciation, around 25%, has been the move in US. That seems to be a bit de-linked right now because of the verbal and the action that we saw last week. But again, I would caution very much that in terms, especially the ones that are not coordinated amongst different countries, are not typically successful. So I think the Ministry of Finance has been set more two-sided, two-way volatility in the market. Again, I don't think that it will be able to basically curb the trajectory higher for dollar yen.
We'll be watching Vasilios Giannakis, Citi's head of European foreign exchange. Thanks so much for joining us.
Well, now let's take a closer look at the broader markets with Charles Schwab Chief Global Investment Strategist Jeffrey Kleintop. So, Jeffrey, as you're taking a look at what markets are reacting to right now, and you're really saying the currency story is the one to keep an eye on. What are the currency markets telling you right now?
I think that's true. You know, stocks have completed this round trip voyage and at their new all-time lows for the year. They rose over the summer, but then have come all the way back. And European stocks have now entered into a bear market as equities rallied from mid-June to mid-August this year. The currency market was skeptical. The dollar continued to rise as this safe haven trade continued in the markets. It's difficult for me to imagine a durable rebound in global equities without the dollar at least stabilizing. And clearly, there's no signs of that today.
Jeffrey, taking a look at the declines once again today, coming off what was a brutal week for the markets last week. At the levels that we're looking at today, do you think we're near the bottom?
Well, that's hard to say. I think one of the concerns is, are we going to get a mild recession or a deep one? I think a mild recession is probably more than priced in at this point. The question is, how much deeper is that going to go? Of course, that's very dependent upon central banks. Do they continue to push higher and higher, wanting to be the Paul Volckers of their era until they get policy rates into real positive territory? Right now, monetary policy interest rates have moved up, but they're still very negative on an inflation-adjusted basis. Big moves would be required to get them into positive territory, as Paul Volcker did back in the early 80s. So if they do that, that's an ugly economic scenario. I'm more hopeful that housing begins to come down, rents begin to come down, and inflation begins to abate later this year in a weaker labor market, but that's yet to be seen. So there are several different paths that the economy can take from here. I think the outlook for a deeper recession would certainly suggest stocks could come down on a much deeper decline in earnings. Remember, it's just been the price to earnings ratio that has accounted for the losses so far.
And so how will you know when you think that the Fed is really near its peak hawkishness?
Well, there's a few things that we can watch. For one thing, we can look at other central banks around the world who may be leading the Fed. About a year ago, we saw rate hikes by the Central Bank of Brazil for emerging markets and Central Bank of Norway among developed markets, a big G10 central bank. They have now indicated that they're probably done. The Bank of Brazil did not hike rates in September after hiking in August, saying they were finished. And the Bank of Norway did hike by 50 basis points, but said they are probably at or very close to the end. They led the Fed by about 6 months. So if that's the case, maybe somewhere in the first quarter of next year, we might begin to see that the Fed can begin to put on the brakes or at least pause for a while and see what's going to happen. But so much is dependent upon rents. It's 40% of inflation, and rent prices are going up even as housing prices come down. Until we see that break, probably due to a weakening labor market, we'll continue to see the Fed pushing down much harder on that brake pedal.
Jeffrey, earnings are going to be in focus here over the next several weeks. They've now kind of been joining inflation, joining the Fed moves as really one of the big concerns here for investors as we start to get those third quarter results. Do you think we're going to see more downward revisions when it comes to earnings? And what are your expectations?
I do, and I just put a chart on my Twitter feed related to this. So we have not seen the normal downward revisions we'd see going the next 2 or 3 or 4 weeks before the earnings season starts. You usually start to see some downward revisions to earnings estimates, and we're not this time. For looking at a global basis, they're relatively stable. That tells me expectations are probably a little bit too high going into this earnings season. Not only have there been unexpected developments take place that could have caught business leaders off guard, but I think their guidance out to Q4 and Q1 of next year, when we're likely in a global recession, probably need to come down as well. So again, I think that earnings, which have been a support to the market here, expecting to rise a few percentage points this year, maybe 5% next year for the S&P 500, the stock 600 in Europe, the Nikkei 225. I think those are a little high. I think those numbers are going to come down, and we may be hearing about it in the next few weeks.
Mm-hmm. So then, Jeffrey, how is that informing your strategy for right now for investing?
I think investors want to focus on quality stocks across sectors, not just try and pick out a sector or two that might be outperforming. One of the ways we've defined quality this year are what we call short duration stocks, companies that get more of their cash flows in the near term than out over the next several years. So that's a lower price to cash flow ratio. Those stocks have been outperforming since interest rates began to rise back in August of 2020. They've outperformed all this year and even in the month of September. So focusing on that is important. Second, I think high dividend payers, a very similar theme. Companies paying a high dividend generally have good cash flow and strong balance sheets. Those stocks have been doing very well this year, not avoided losses, but really have only experienced about half the losses of the overall market. So that's another theme investors want to keep in mind. High dividend payers in every sector are outperforming. You don't just have to go to those classic high dividend payers in, say, utilities or telecom. You can find them even in the tech sector. The highest dividend payers are the outperformers.
Jeffrey, if you have some cash on the sidelines right now, like some of our viewers likely do, are you putting money to work, or should investors wait maybe for some of this volatility to calm down?
Well, I think you can use volatility as your friend. If you've got a long time horizon, you've got some cash, I think dollar cost averaging into this type of a volatile market does make long-term sense. I think trying to pick a bottom is very hard. Increasingly we're seeing more value even in the bond market despite the sell-off there, with high yield bonds now yielding over 9%. We've got, dividend yields in the U.S. are now higher than they've been in quite some time. So I think you have the opportunity to buy in and wait and pocket that yield even as you wait for prices to recover.
And Jeffrey, what are you steering clear of in this environment?
I still think there are some stocks that really benefited from the liquidity wave of recent years in the tech sector and in other areas that long duration stocks, those companies with very lofty growth prospects in the future. As liquidity continues to be drained and financial conditions tighten, those may fare the worst. So those are the highest price to cash flow stocks, what we call long duration stocks. You can find more of those in the growth sectors of the U.S. stock market.
Jeffrey Kleintop, always great to get your perspective. Thanks so much for joining us. Well, big story of the day, the British pound falling to an all-time low against the dollar in earlier trading, prompting speculation that the Bank of England may have to raise rates more aggressively to tamp down inflation. Let's bring in Mark McCormick, TD Securities Global Head of FX Strategy. Mark, it's good to see you. So we have a surging dollar, the pound plunging, euro at a 20-year low against the dollar. Just help us make sense of the moves that we're seeing in the FX market and what this means for retail investors.
Right. So this is a function of global dynamics, global growth dynamics, which you just discussed. This is also about central bank policy, the inflation theme, and also terms of trade. What's happening in Europe is they're dealing with a massive terms of trade shock, which means the cost of imports are rising. They have no control over energy prices. And so real rates, the rate the central bank has, nominal rates minus the level of expected inflation, are moving against European currencies, which is pushing them dramatically lower. If you think about sterling, what we got is basically a fiscal package, which is there to design to support growth, but it comes with basically no tax revenue buildup. All of it's supposed to come through economic growth. There's no real challenge to how they're going to spend money. And so basically there's been a loss of confidence in the gilt market in sterling. So that's why we've seen the collapse there.
And for multinational companies who are watching this happen, what do they need to be keeping an eye on right now?
Well, yeah, you have to think about how these three factors work together. We've got the global growth dynamics, which are quite important. You have to think about what's happening in China. Again, we still have the zero COVID policy. We're on and off in terms of whether or not things can grow there. What we have is basically Asia and China in general is trying to ease financial conditions. They're cutting rates. They're trying to stimulate growth. They are dealing with low inflation. In the U.S., it's different. The U.S. is dealing, they're trying to tighten financial conditions. They're trying to raise rates. They're trying to take some steam out of markets in general. And in Europe, the financial condition shock has been imposed on them, again, by these forces related to the cost of energy and electricity and the terms of trade shock. So I think what investors need to kind of keep their eyes on is really all the world's most important regions are divergent. And the way that the world kind of absorbs these shocks is through the currency market. And that's why there's so much volatility. This is why currencies are doing different things in different regions. But the key thing in the very short term to keep your eye on is we have an inflation report coming up that's going to be very critical. We had a very good inflation report, then we had a very bad inflation report. And now we've seen, again, a pivot in the Fed's relative hawkishness, which kind of, dovetails with what we've seen in the latest report. But if we get an inflation report that's a little bit more benign than market expectations, we might see some pressure come off in the very short term. But again, for the next 3 to 6 months, we're still dealing with a challenging global growth environment. We're still dealing with persistence in terms of figuring out where central banks stop in terms of their terminal rates. And then lastly, again, this ongoing terms of trade shock is not going to dissipate through the winter unless we get very lucky and have a warm winter in Europe.
Mark, it doesn't seem like anything is stopping the dollar's momentum, at least right now. What's it going to take in order for us to see the dollar peak?
Yeah, it goes back to the inflation in the very short term. We have these indicators, we call them stagflation indicators. What we're doing is looking at relative global inflation versus relative global growth expectations. Dollar's running about a 12% premium, which is pretty unheard of in a framework like that. So if you kind of look at also the correlation of the 60-40 or the risk parity portfolio, the dollar is like the perfect stagflation hedge. You get a little bit of a yield. It's negatively correlated with equities. And so if you have a bearish view on equities and credit, the dollar is a great place to kind of sit there and wait things out. So for things to change, we need to see inflation numbers. And again, I think what people are a little bit too focused on the core numbers, because core is 40% of that is represented through the housing market, which again, the Fed has very little impact on the housing market in the very short term. But I think the things we want to continue to see is the downside in commodities, the slower move in producer prices. Again, the fact that we're seeing supply chain indicator stress start to alleviate are good signs, but we need to see the next inflation report come in line expectations with markets. That'll help cool things a bit. But for the full turn in the dollar, we're going to need to see the global economy start to recover. So we'll need Chinese financial conditions to kick in. We need to see Europe kind of work through this terms of trade shock, which is going to, again, take us through the winter. And we have to see kind of global peak inflation. So those are the three factors.
And Mark, not to put you on the spot, just when we're trying to gauge, I guess, where we're headed from here, 6 months from now, where do you see the dollar?
So I'd say in 6 months, it's still relatively resilient. I'd say if you want to go 9 to 12 months, we have a very big drop expected in the dollar. I think one of the things that people have done through COVID, which has been very challenging, is you're kind of taking these peak extremes that have been pulled in through the pandemic itself and extrapolating. If you extrapolated from where we started with COVID, we would have never seen a recovery in the economy. We saw a massive rebound in data surprises and data expectations through, right after the economy started to reopen. We had a massive reflationary trade because of all the stimulus we got. Now we've seen the removal of the stimulus and some of the normalization. So I think to extrapolate this world, the one we're in now for the next 12 months is going to be challenging. I think the next 6 months, we still have the dollar generally resilient, but I think it's starting to turn over and we're starting to forecast a lower dollar 6 months out. I think if you want to go 12 months, we do have the dollar falling by, the levels of some of the risk premium that's embedded there by 12 to 14% against specific currency pairs.
And Mark, I just want to quickly ask you about the new Italian Prime Minister, obviously Italy, the third largest economy in Europe. What are you keeping an eye on there? And do you expect any shifts as a result of this?
No, it's very interesting that for the first time, Italian politics has taken a back seat on European currency moves to UK-based politics. I think, again, what people are going to be watching here is the BTB bond spread. Is there a lot of pressure? It does seem like a lot of what we've seen from Italy has been a lot of rhetoric, and the rhetoric so far hasn't really matched anything in terms of policies seemed a little bit more tempered relative to expectations. The prime minister was kind of saying the right things. So I think in this regard, Italy's kind of a secondary force. I don't think it's a big driver. I think we knew where we were going. So there's not too much that we're watching there. I think you're going to want to see some of the spots, who's going to be leading the finance ministry and some of these key appointments. But other than that, the market's just going to continue to monitor the BTB and bund spread. But for this moment right now, euro sterling and European currencies in general is really going to be dominated by what's happening in the UK fiscal policy rather than European politics.
In this episode of Influencers, Dice founder and CEO Phil Hutchin, along with Tony Fadell, Dice board member, Nest founder, and inventor of the iPod.
humans need to be around other people. I mean, it's one of the things that make us like human, and seeing like an amazing performer is one of the things that you remember for the rest of your lives.
There's always unintended consequences in everything, and technology is neutral. It's what we choose to do with it and how we regulate it and what we socially accept. I think we got a lot of fish to fry, and we are frying ourselves. So I think we need to spend more time on fixing the climate than we need to worry about getting into the metaverse.
Hello, everyone, and welcome to Influencers. I'm Andy Serwer, and welcome to our guest, Phil Hutchin, the founder and CEO of Dice. Also, Tony Fadell, a board member at Dice. Tony, as you may know, former Apple executive, iPod inventor, iPhone co-inventor, also Nest founder, and a principal at Future Shape, which is an investment and advisory firm working with engineers and scientists, developing foundational deep technology, I should say. Got all that. Okay, we want to talk about Dice. And Phil, why don't you start us off by telling us what Dice is all about and what you guys are doing?
Yeah, no problem. And nice to see you, Andy. Well, first of all, Andy, have you ever bought a ticket?
Yes, I have.
And how was that?
Not so good, Phil.
And so I think that every time we kind of ask someone if they bought a ticket, that has ever come back to me with like this, like, oh my God, it was amazing. It was always like, I bought a ticket, I thought it was one price and it was another price, or I couldn't buy a ticket and it was thousands of dollars or whatever it was, or, I missed out on the show, whatever it is. And so there's lots of problems around it and, the opaque nature of the industry. So Dice is a super simple way to find out what shows are going on. 2 taps and you've bought the ticket. It's killed scalping. And if you can't turn up to the show, you tap a button and you get a refund. And it's just making all those things traditionally associated with, going to a live experience, they're gone. And now it's just very easy.
I have a million more follow-up questions and we'll get to them. But Tony, I got to ask you, you joined the board of Dice in September. What made you a believer? And why join at a time when the live music industry is still getting back on its feet with COVID?
Sure, Andy. As well, it's great to see you. So for me, music's in my blood. Given my past, and I'm from Detroit, right? So when I was in Detroit, exactly, Ticketmaster first came out, and it was like a revolution. I could go walk down to a local store and get a printed ticket. You didn't have to go to the box office, and so that was an incredible innovation for me. But since that part, they haven't innovated a lot. It's still like, okay, what can we do to extract more money from the fans? Really, is what it is. And it hasn't been about more convenience, about more access, making it easy. You can say what you want about airline ticketing or other travel ticketing. At least you can exchange tickets, upgrade them, change the dates, everything. You don't have any of those conveniences at all in the entertainment ticketing world or sports ticketing world. Well, that's what Dice is trying to solve. And because I'm such a music fanatic and have been suffering with these things for years, I met Phil, and I didn't just get involved with Dice this year. I've been involved with Phil and Dice, 5-6 years now. So this was like literally when they were like 10, 12, 15 people. So we've been working together with them and just been, because of the experience that they really want to bring. Fans first. It's all about the fans. Even the artists, the venues, everyone understands that. More fans. And especially today when, bands are not making any money except for merchandise and for entertainment events. Other than that, they're not making any money on streaming. We see that unless you're the top, 100 artists, they don't make any money. So where are they going to make their money, and how are they going to make sure the fan has a great experience? That's what Dice is all about.
Phil, I got to ask you about the competitive set. I mean, Tony mentioned Ticketmaster. They're still around. StubHub, Eventbrite. What sets you guys apart from those companies, and how are you going to build your brand?
Right. So I think I kind of touched on it. Like, our only customer is the fans, and that was something that we established on day one. So everything that we build is for that fan experience. So when we're building things with partners or venues or artists or anything else, we always ask the question: is it good for the fan? And I think that the second thing is that Dice is just software. So if you're looking at Live Nation, I mean, they do huge productions, they do all these things. Ticketmaster is part of it. We're just like using software to bring fans and artists closer together, like helping them, decide which cities they're on, how much they should be charging, all these things to make it super efficient. And I think that the third is that we're able to scale much quicker around the globe. So I mean, we started off in London, but now we're in the US, in France, Spain, Italy, India, Australia, moving into Southeast Asia. So it's like it's kind of, there's a global network effect that happens as well, because you're giving that data to artists to help them plan global strategies themselves. So it's just really, when we're talking about empowering artists, it's like helping them control their cash, so they own the cash. They can pay people and do things instead of waiting for someone to pay them.
How do you mitigate against scalpers? You mentioned that. Can you drill down a little bit more there?
Yeah, cool. So this is, I mean, it's like one of those things where in hindsight, it's like so simple, but there's nothing to sell. When you buy a ticket on Dice, there's no ticket. And so there's nothing to screenshot. There's nothing to pass on to somebody else or anything else. Just moments before the show, there's like, an animated a QR code that goes around, which, is there, but it's a very elegant, simple solution, but it's a way that, if you've got nothing to sell, then it's impossible for scalpers to put it on any platform because they don't have anything.
And how much of the business, Phil, is reliant upon the return of live music to pre-pandemic levels? And what is your prediction about when that'll happen?
So we've just spent 18 months, or give or take, like sort of stuck in our homes, been entirely digital. And you're thinking about one of the things that I didn't appreciate, at the beginning of Dice, and kind of really kicked in sort of just before the pandemic, is that we saw some data in terms of loneliness for people aged between 17 and 21, and a third of them expressed that they had intense periods of loneliness. Even before the pandemic. You put the pandemic on, everyone kind of living digitally. The return to live since summer, it's been insane. I mean, every record has been broken at Dice in the last, 5 months. When we're looking at the data, like still now, shows are completely packed, like the venues are packed, everything else. You read in the newspapers that, people have become hesitant about stuff, and then you go to live concerts and they're absolutely full. And I think it's kind of going back into what I was talking about with loneliness, that humans need to be around other people. I mean, it's one of the things that make us like human, and seeing like an amazing performer is one of the things that you remember for the rest of your life. So, live experiences, I think that people are actually appreciating them even more as a result of the pandemic.
Yeah, Phil, I've been giving Tony grief about musical preferences. I'm going to hit you a little bit. Like, I don't know if it's Adele or Coldplay. You know, I'm doing the UK thing with you. So do you work with the artists or do you work with the venues? So in other words, here in New York City, MSG, Madison Square Garden, are you selling tickets for them or are you selling tickets for Adele?
So we do it for both, but the focus is largely on venues because many artists play venues. But we have an artist development team, and that's part of the idea of the global network is that Dice has venues all around the world, and then artists want to play those venues, and we help them kind of connect them with those venues via their agents or the bookers or whatever else. And then part of that is, so I've got an example. So it was an artist in London called Bicep. They started off with us from the very first show, 200 people. And we made the deal with them, like, cool, sell exclusively through Dice. And let's kind of like build up this live story. And then from that, you're not allowed to spend any money on social media advertising. You got to trust into your audience, but get the story right. Now they can sell 50,000 tickets in London. And it's kind of like taking them at each of those steps all the way through. And throughout the whole time, Bicep understood their audience. They knew what they wanted, where they wanted to play. They had control over, their live strategy. And this is what we're doing at scale now.
Right. And so do you cover all the venues in the world, or are there some venues that are not a part of your ecosystem yet?
Yeah, so we wish we had. Well, we have all the best ones, or most of the best ones. So there's some holdouts, but there's other people who have the ticketing rights for those venues. But we have it's 3,600 venues sort of around the world, which is increasing, day by day. And we also work largely in major cities. So in New York, over 1 million people used Dice last month. And so there's quite a big spread of venues in New York. And for that, it's the same in Paris and Barcelona, all these things, because there's lots of events happening there. So the discovery engine is really kicking off. And our thing is that if you want to see a show once a month, then let's get you to a show once a week. How do we reduce the friction for you to actually, get there? So, our competition is like people staying at home watching, Netflix. Is like, okay, well, how do we make it as easy and compelling to kind of get out and see something? And it works. I don't think anyone's been to a great show and said, well, I'm not doing that again. So it's the exact opposite.
Tony, while I have you here, I got to ask you a few questions about Apple and the iPhone, Silicon Valley.
Oh, God.
So you were on the cutting edge in designing the iPhone, but it's been around for a while. What do you think is kind of the next big thing in terms of consumer tech? Thoughts on the metaverse? Those are two big questions happening right now.
Well, the big things on the horizon for consumer electronics, we're hearing more about, augmented reality and these kinds of things. We're hearing about the metaverse. Frankly, I think we got a lot of fish to fry, and we are frying ourselves. So I think we need to spend more time on fixing the climate than we need to worry about getting into the metaverse. So let's make sure we have an environment we can live in before we find another environment that, keeps us in like refrigerated chambers and, so that we can breathe and eat. So that's how I feel about the metaverse, but on consumer electronics, I think, a lot of this stuff, people think that this is going to be the next big thing, like augmented reality. I think it will be for certain very niche verticals, but not necessarily like the consumer thing that you need. Because, we saw this before. You got to need the technology, and then you have to understand that the consumers want it, right? And they want to live with these things on it. And it's social acceptance, not just you accepting it, but the people around you accepting it. And that I've learned all the time is, the technology might be right, but is the social timing right? Is there a social acceptance? And are you truly delivering a pain killer because there's a clear need, there's a clear pain? The iPhone solved a need, right? It was on the go, internet, email, media, these kinds of things. We don't see the need yet for the metaverse, and then to have the metaverse wherever you go on you. We already tried that with Google Glass. I think it's going to take a little while.
Yeah, and speaking of Google, you invented, helped create the iPhone, the iPod Nest, which was bought by Google, and these products are networked now in a huge way. What is your take on both the upside and the downside of this massive amount of networking that some people say, leads to dystopian possibilities, but also tremendous upside?
Well, look, there's always unintended consequences in everything. And technology is neutral. It's what we choose to do with it and how we regulate it and what we socially accept. So we have to do things that promote social bonding, like what Phil's doing with Dice, right? Not letting the ticket bots in there, not letting the scalpers in there, doing all the things necessary. And that's why I love what Phil and Dice is doing, is they're trying to bring all the best things to connect the artists to the fans, right? And getting rid of all of those middlemen who are just stealing along the way. So that's what we want to do. And I love the network. It can have better shows, have the artists make more things for their fans so that the fans have a better and better experience. And maybe through that, we can create even more social movement to fix some more of these problems. But it's about bringing people together and not about a network of intermediaries stealing along the way.
All right, just one more Wayback Machine question.
Okay.
Okay. And that's, you worked with Steve Jobs.
Yeah.
Apple built a music business when you were there. What did you learn from Steve, and what do you think he'd be thinking about the world today and the technology that we're using?
Well, I think for me, what it was all about in the music store and the iPod, it was always about, what do the customers really want? What is going to give them that that emotional experience that they crave, that they want, and a rational part of that, making it simple and all those other things. And that's that's like Dice. So when you see something like this, you're like, wow. I think that if Steve was here today, he would go, we need to get artists more money. I think if he looked at the streaming services out there, I know how much he loved musicians, bands, and wanted to support them. I remember way back when he was looking at buying certain media companies, that kind of stuff, because he really wanted to revolutionize that. And so as far as I'm concerned, if he woke up today and saw the streaming services the way they are today and where the artists are not getting fairly paid, he would fix that. Absolutely.
I remember Tony and Phil when he came by and demoed the iPad at Time Inc. when I worked there, and he played music and he played Friend of the Devil. And I said, oh, the Grateful Dead. And he goes, I love the Grateful Dead. You can see he really meant it, right?
Yeah.
He was really passionate about that. You come from a musical background, a music industry background, I should say. But geez, what made you decide to get into ticketing?
Yeah, I mean, I wasn't tech before going into the music and not knowing anything about the music industry. So very naive, but very lucky in the music industry that found some artists who were getting bigger and bigger, and actually didn't care about ticketing, didn't understand it, because you spend so much time working with the artists and making an amazing album, to make an amazing artwork, to looking at their live show, and didn't think about the ticketing until the artists started getting bigger in North America, and that was when I suddenly was like, hang on a minute, we did a deal for $40, and now the ticket's 65. Where's this 25 going? It's sold out, and it's been sold for hundreds, thousands of dollars, and all the fans are angry at the artists. Like, why isn't anyone fixing this? And so then I went back into sort of old world, new world together, and just analyzed all the ticket companies and tried them all out. Didn't want to, just trying to see if there was a solution. And that was the thing. Well, if no one else is going to fix it, I guess that we have to do it. So, and kind of just touching on to the last question as well. I think that take a lot of inspiration from what Tony created. Really thinking about the small things. The experience when someone sees it. Small little animations within the app, the ticket, the imagery. You're talking about brand before, like people wear Dice t-shirts and have the bags and everything else. Like, all these things are like things which we really care about, because you need to make a revolution, and all this stuff like pays off because eventually, because of all these things being put together.
XLE leading the way, up nearly 2% in terms of what's lagging. Consumer staples and utilities, the two worst performers. Dave?
All right, thank you, Shauna. Let's get you up to speed now on housing, which really right now depends upon your perspective. Some new numbers out from CoreLogic show U.S. home prices in July cooled at their fastest pace in the history of the Case-Shiller Index. Nationally, prices are higher than a year ago and rose 15.8% from July to August. That's a lot, but well below the 18-point increase the previous month. So again, prices are still growing. They're just growing slower than before. Outliers here include Tampa and Miami with stunning increases. Look at that. 31.8 and 31.7% respectively year over year. That is dramatic. And overall, our dire thoughts about the economy brightened a bit with consumer confidence actually improving for a second straight month. Another surprise here. The Conference Board reporting the baseline index rose to 108 from 103 in August. We'll get University of Michigan numbers at the end of the month. And Rochelle, as we toss back to you, we will hear from a Miami broker later in the show to get a better sense of what in the world is going on down there with prices up more than 30%.
That's right. Now, before we get to that, though, we're going to get you up to speed with what's happening with Hurricane Ian and its impact on oil and gas prices. We did see oil bouncing off a 9-month low. You have WTI and crude both up there. WTI up about 2%. Brent crude up about 2.5% there. Also taking a look at natural gas, that's down fractionally. As we can see there, that's down about 2.9%. As you look at RBOB as well, that's actually up almost 5% there, for about 4.5%. Now, late Monday, of course, we heard from BP and Chevron. They actually cut production at offshore oil platforms in the Gulf of Mexico and evacuated personnel due to the storm. That affects about 485,000 barrels per day, or less than about 5% of U.S. oil production. But of course, Florida bracing for the worst of the hurricane. Now, it's not a major producer or refiner, which is why RBC Capital Markets analyst Michael Tran says this is not going to be a meaningful event for the global oil market. But of course, you have the domino effect of delayed deliveries due to evacuation, flooding and wind damage, all of those weighing on oil markets that were already under pressure amid broader market losses that we're seeing across the board. All right, well, let's take a look for more on the broader markets. We're joined by Bill Smead, Smead Capital Management CIO. Welcome back to the show, Bill. So I want to get your take on what the markets are digesting right now as we continue to see a choppy day for them.
Well, we call this a nasty bear market, because it's a bear market that's designed to cure the sins of the prior euphoria episode. So the punishment has a tendency to match the crime. So you've had a huge set of manias. Charlie Munger, Warren Buffett's right-hand guy, says this was the biggest financial euphoria episode he's seen in his career because of the totality of it. And so what we're seeing now is a rotational bear market that is moving from one inflamed euphoria segment, whether it be crypto or whether it be FANG stocks or whether it be high price to sales, et cetera. They're just moving from one to another. Now they're moving to venture capital and private equity. And before it's all done, they will have crushed a lot of that stuff and paid back the punishment for the sins of the prior episode.
Bill, what do you make of the conflicting commentary that we've gotten from Fed officials today? We had St. Louis Fed President James Bullard. He was saying that more rate hikes are needed. Economic risks remain elevated. Kashkari, on the other hand, saying that there's still a chance of a soft landing. What do you think?
Well, we're a bit conflicted ourselves. We see the fantastic demographics. There's 41% more millennials than there are Gen Xers. Therefore, that's 41% more 26 to 43-year-old consumers of everything from houses and cars to getting married to having kids to do all those things that create necessity spending. And necessity spending is the most favorable spending to what we used to call the multiplier effect in macroeconomics. So that you've got that favorable backdrop. Then the second thing you've got is you've got the chronological snobbery in operation here. So I'm 42 years in the investment business, and for 32 years, 7% would have been a great mortgage rate. But because the rate was almost nothing a year ago, people act like this is the worst thing that's ever happened. So back when baby boomers were a huge group, my first mortgage was 13.5% in 1983. And by the way, in 1984, we built a ton of houses at double-digit mortgage rates. So I think people are missing the boat. We're going to have more permanently higher inflation, probably in the 5% variety. I think the mortgage rate at 6.5 or 7 is doing a pretty good job of discounting that inflation, and therefore whatever softness the landing might have might be because of better necessity spending than people had assumed.
Still trying to digest chronological snobbery, Bill. That's a new one that I have not heard before. But back to those mortgage rates, if you are in a home, you're looking to upgrade, and your mortgage is, say, high 2s, low 3s, that's a double your mortgage payment if you're looking to go buy a new home right now. What do you think lies ahead for the housing market?
Boy, I hate to burst your bubble, but that is a lousy question. What you're asking is are older millennials who got completely spoiled by what's happened to them on their first or second home purchase are going to damage the economy because they don't get to stay as entitled as they were before. That's not who we're concerned with. We're concerned with the millennials that are getting married this year in record numbers and next year, who are going to want to buy their first house. That's who we're going to build the houses for, is to meet the demand for the necessity, not the fantasies of the millennials who have spent their 20s going on exotic vacations.
There are no homes for those first-time home buyers right now. They're not building them. You're aware of what's going on in the real estate market. Developers, builders, they flat out don't buy those homes. And are you meaning to suggest that if your mortgage payment is going to double, that you want to support the economy and just swallow that because you're spoiled?
No, you're missing the point.
Please explain
the point
again.
Is, I drove from Phoenix to Portland, Oregon, and back 2 different ways, and most of what I passed was empty land. 75% of the United States is uninhabited, and many of those uninhabited places are wonderful places to live, like a Klamath Falls, Oregon, or a Bishop, California. And what you can't do is you can't live in an elitist coastal city and find affordability. But you also don't have to live in an expensive coastal city. You can live wherever you want because all you need is water and Wi-Fi. So Lennar and D.R. Horton are they're going to build homes where people can afford to live, and businesses will locate themselves in a place that's affordable to live. So, for example, let me take you back when Amazon was trying to find a second headquarters. The obvious place was Detroit, Michigan. Fantastic airport, 2 huge state universities to pump grads into your business, and affordable homes in Bloomfield Hills and the rest of the suburbs of Detroit. Now, did they consider that to be a good idea for 1 second? No, they picked New York is where I'd rather be, right? That is what they chose because it had nothing to do with affordability. It had everything to do with arrogance, not affordability. And that's what you're wrestling with. Where are people going to locate their businesses and where are people going to live? And right now, that's not downtown Seattle.
I would love to continue this chat for the next couple of hours. Unfortunately, Bill, we got to roll on to the next segment. Bill Smead, we really appreciate your time. Come back. Let's continue this real estate discussion. Ahead, we're just getting started here on Yahoo Finance Live. We got a very surprising piece of housing data this morning. We'll break down the numbers for you. And new car prices remain high, but there is one area where you might see some price softening later this year. We'll tell you what that is. And if you're planning to fly during the holidays, our expert will tell you the best time to buy those tickets and the best day to travel. Stick around.
Welcome back to Yahoo Finance. Now, lumber prices are rebounding today from a 2022 low. Ines Ferre has more on the price action of the essential building material. So for more, we turn to Yahoo Finance's Ines Ferre. Ines, what are you seeing now?
Yeah, Rochelle, we are seeing a bit of a rebound, but keep in mind that just yesterday, lumber futures hit a 2022 low. So let's take a look at the charts on our Wi-Fi Interactive. You can see that lumber futures right now just above $431 per 1,000 board feet. One board foot, by the way, is a 12-inch by 12-inch wide piece of wood. So basically, you are looking at these lumber prices that have basically plummeted year to date. You're looking at the price action down 61%. And a lot of this, of course, has to do with the rising mortgage rates. So as we are seeing a slowing housing market and mortgage rates are inching closer and closer towards 7%, you've got home builders that are shying away from buying materials. You had KB Home, you had Lennar in their recent quarterly report basically saying that they canceled some lot purchases. I also spoke to a commodity broker who told me, look, because supply chain issues are better now, there is no sense in a slowing market for these home builders to be piling up wood. So you are looking right now at these levels that are pre-pandemic. I'm going to pull up now a 3-year chart. Let's see. I'm going to pull up a 5-year chart here so you can see that you are looking at pre-pandemic levels for lumber. Lumber losing all of its pandemic gains, guys.
Indeed. All right. Thank you there, Ines Ferre. Dave?
Thank you, Rochelle. More now on the housing market. Mortgage rates, as we mentioned there, continue to climb, headed towards 7% on the 30-year, more than doubling from a year ago. Inventory remains low. Prices are cooling across the country. Contracts are being canceled and projects stalling. And then, surprise, new home sales today shooting right back up, jumping 28% in August. That's according to the Department of Housing and Urban Development. 685,000 new homes were sold just last month. Shana, the dynamic overall has not changed in a number of months. We will continue to see exceptions, bounces here or there, but overall, the Fed is determined to win this fight, and we saw housing begin to struggle before any other portion of this economy, and we're going to see that falling off in prices across the country with notable exceptions. Miami coming up later in the show. They will win this fight, and the problem is these mortgage rates are keeping sellers and buyers on the sideline, because as we argued with Bill Smead, you're not going to upgrade to a bigger home if you're going to pay double your mortgage rate right now. You're just not going to do it. And you're also not going to sell right now because of that.
Exactly. And also, if you're a first-time home buyer, you now have a less likelihood of being able to afford a home with a mortgage right now, nearly double what it was during the pandemic. So comparatively speaking, obviously, the housing market here showing signs that it is slowing. The new home sales number stuck out to me. Yes, you can take a look at that number, 29% jump. Yeah, we have seen some commentary, a number of economists weighing in on this. Greg Dacko of EY Parthenon, he was on the show yesterday. He tweeted out this morning that this number was likely a head fake, because you also have to keep in mind those inventory levels. Simply, home builders are not building the number of homes that are needed right now in order to really help with supply. You also have the fact that sellers aren't selling because of that higher mortgage rate that you were just talking about. Zillow was out with a report saying that new listings dropping nearly 23% in August from a year ago. So, Rochelle, it's hard. I mean, I don't think there's any argument to the fact that, yes, the housing market is slowing, but obviously the degree of this slowing and what we could potentially see over the coming months is what people are debating right now.
I mean, and it's tough, though, because as we see, mortgage rates, when you compare them to where they were, say, in the 90s, obviously compared to back then, things would look pretty good. But you have to remember, we were in a place where we had historically low mortgage rates for a very long time. And even over the course of the pandemic, when you look at the size of the millennial population, households have grown, the size of them have grown. So they do still have a need to get into a place. Rents are still too unaffordable. So there is that need. They do have a need for these things. So it's interesting to see then, though, a lot of these lumber, these home builders saying, look, it's not worth for us to do it right now if some of these people just want to stay on the sidelines. But at a certain point, as we're seeing, though, once we saw some of this, the frothiness, we saw people sort of waiving everything, waiving every contingency with houses. Now that we're not seeing that as much, perhaps we might start to see people trying to come back into the housing market for the first time.
Yeah, the people that you are hearing from right now are those that bought at that massive peak in the pandemic. Those are people who are worried, who are inevitably going to lose 20 to 30% of their value because they bought at ridiculous rates. Now, those that want to say this is like 2008, 2009, 2012, nothing like it. We're not built on a house of cards like we were back then with those types of loans being thrown out. And the bottom line is the inventory, though it's coming up, is still historically low. So these prices don't have very far to fall.
Yeah, and it's also interesting just looking at some of this data in terms of home buyers backing out too. Like that's another dynamic that's playing out right now, especially in some of these Sun Belt cities. And these were the cities that attracted so many people, so many new homeowners during the pandemic boom. The fallout that we've seen there, Jacksonville, Florida, 26% of buyers backed out of contracts in August. Las Vegas, 23%. Atlanta, nearly 23%. Orlando, Florida, which you are just back from, nearly 22% of buyers backing out of these contracts. So as we start to see potentially that picking up as well, obviously this could really spell much more trouble here for the housing sector at large.
And you certainly did a bit of more than you can chew when you signed up for this before the rate right-sizing period kicked in. So a tough spot for homeowners and those prospective buyers right now. All right, well, coming up, Domino's shares taking a hit after an analyst lowered the company's price target. We'll give you the reasons why next. It's time for Triple Play, the three stocks that we're watching in the final 30 minutes of trading. We have Keurig Dr Pepper, Domino's, and General Motors. So we're starting off with my pick, which is Keurig Dr Pepper, ticker symbol KDP. Now, shares of the beverage maker under pressure this afternoon, down about 3% there, falling this afternoon after a downgrade from Goldman Sachs to neutral from buy. Now, as the reason for caution, Bonnie Herzog and her team at Goldman really cited an increased risk to margins as commodity inflation, especially coffee-related, remains remains elevated for KDP versus its peers based on Goldman's updated commodity tracker. So they also lowered full year 2022 and 2023 estimates slightly, putting them below consensus. Now, on top of that, though, you have other headwinds for KDP that include brewer household penetration starting to normalize. You have pod attach rates moderating, and then, of course, a slowdown in their packaged beverage business growth market and market share gains also slowing as well. But not all bad news. Goldman also said that KDP is still executing well despite the challenging environment and also has strong underlying momentum in its coffee and packaged beverage businesses. And they also highlighted ongoing initiatives to expand and enhance distribution capabilities. So clearly not a bad day for KDP at this point, but obviously that caution, though, really weighing on the stock there. As we said, they're down about 3% today, Shauna.
Yeah, higher commodity prices, obviously an issue here for Keurig Dr. Pepper, also an issue for many of their peers out there. It's interesting, though, that this call is coming out now because the company has actually been able to weather the uptick that we've seen in coffee prices relatively well. Taking a look at that one-year chart, the stock is still in the green. Yes, it's getting hit today because of this call from Goldman Sachs, but over the past year, stock up still about 6%. So we'll see how high potentially the coffee prices might climb and when, of course, that would be an issue here for Keurig Dr. Pepper. All right, my play today, Domino's. Cowen lowering its price target on the stock because of two headwinds, they say. Delivery driver staffing levels and also a slower pace of store openings potentially. Now, analyst Andrew Charles writing in a note that staffing levels for delivery drivers has plateaued in the current quarter, and that quote does not lend confidence to an acceleration here in three-year trends. He also pointed to a risk that 2023 openings trailing the 6 to 8% long-term guidance that we got out here from Domino's ahead of time. Cowen updating its price target to just about $362, comparing that to where we are today at $314 a share, still about an 11% upside. So yes, Cowen reining in some of their expectations, Dave, when it comes to what they expect to see over the next 12 months, although still much higher from where we're trading today.
Contreras is BMO analyst Andrew Strelzik. He's got a buy and a $430 price target. That's a 35% upside, citing their own survey that says 80% of their own respondents indicated a desire to increase spending over pizza in the next 6 months. This is recession food. Domino's Pizza, you know, is my personal favorite. And if we do hit a recession,
I don't understand that, but that's a whole other
$8 3-item pizzas is a steal.
You can't beat the price, the taste you can beat elsewhere. I know, we can debate about it. We live in one of the best cities for pizza, and you order Domino's.
It's tremendous.
All right,
it's
we'll
delightful. I'm going to get you some Domino's. You are going to love it. My play is General Motors throwing return to office plans in straight reverse. On Friday, GM announced plans to bring corporate workers back to physical locations at least 3 days per week later this year. After significant backlash from employees, though, today they walked back that plan, saying they won't be mandating specific in-office days, and they'll leave that up to the individual teams. GM said it will announce further updates by the end of next month after spending the next few weeks, quote, continuing to listen to feedback. Now, Ford, on the other hand, has also updated its return policy, recently emphasizing their increased flexibility is what they think is a real advantage in hiring top talent. Shares of GM down more than 40% year to date and down today just about 1%. We're down much bigger earlier on. Overall, part of a much bigger discussion on return to office plans. And clearly right now, Rochelle, it looks like a tight labor market is going to win out because all these companies get out there, they announce these plans, and then they slowly walk them back over backlash. And that looks to be the deal until a recession, if a recession hits, and then we might see everyone return to office.
I mean, it's true because we've seen the stick method where they try and force you to come back. We've tried the carrot method where they'll include all kinds of perks. They're like, oh, you want to play pickleball? You want to do this? But at the end of the day, though, from the surveys that I've seen from different work from home surveys, the main reason that people aren't coming back is because they have a lack of compelling reason to want to come back physically. If they're seeing that they're just as productive outside of the office, they're trying to find a reason to have to come back. And WFH research actually found that just 49% of employers who told them they had to return to the office full-time 5 days a week actually ended up turning up. So you can't really like reprimand or fire people in a labor market this tight once you've really invested in them. So I don't think this is changing anytime soon until, as you mentioned, recession hits and the job losses become more severe and people really have to think twice about it. But at least for now, does seem to be in the employees' favor, Shauna.
I don't know. It could happen much sooner than we think. If we do start hitting some of those unemployment projections that the Fed has said, we certainly will see. They think we will see a slowdown in the labor market, in the jobs market. So, of course, that would give management at some of these companies an upper hand because employees won't have too many options, at least to go elsewhere for the time being. I still think this whole return to office saga, how it's playing out, is interesting to me because it makes sense to be back in the office. I get the whole hybrid schedule. I get that maybe you only want to be back 2 or 3 days a week. That makes a lot of sense. But being back in the office is much more productive, I think, team-wise, than everyone working from home, just in terms of the culture, building relationships, being able to have those one-off conversations, especially with your manager. That doesn't happen as often when you are working from home, at least when we were working from home from some time before we came back to the studio. So I think there is a reason. I do think these managers have a point here in trying to get their workers back to the office, David.
Yeah, and also don't factor the sideline deals. And I'm not just talking about big deals that are made like at conferences, but what happens on the sideline, whether it's after work at getting a beer, makes a huge amount of difference. Unfortunately, we can't have a debate here. We all kind of agree. Rochelle, get back in office, all right?
I know. Rochelle, you got to move up here to New York.
Half the people say, no thanks. So what can you do?
All right, well, moving on here, the Department of Transportation announcing it has approved all 50 states' plans for the first nationwide network of EV charging stations. We'll find out how big of a first step this could be next. Like many consumer goods, the cost of cars remains high. But our next guest, though, says that there may be some relief on the horizon. We want to bring in Edmunds Executive Director of Insights, Jessica Caldwell. Jessica, it's great to see you here. So the cost of new cars obviously remaining high. We have started to see some relief when it comes to used cars. I guess, do you expect that relief to stick? And when should we expect to see the cost of new cars follow suit?
Mm-hmm. Well, it's not, I would say, absolutely fantastic news, but what we have seen this year recently is a return to seasonality in the used car market, because every year we see January used values are a little bit higher, and as the year goes on, they decrease. They get older, they have more miles, a little bit more wear and tear, so it makes sense that a used vehicle in September is cheaper. However, that's not what we've seen in the past few years because the car market has been so topsy-turvy. So I feel like that is the first good sign that things are sort of going back to normal. Things are, used cars are still expensive if you compare them year over year, but at least we're not seeing that atypical non-seasonality phenomenon that we've had for the past few years.
And Jessica, it feels like we used to get bombarded with all these blockbuster sales for used cars and new cars. It doesn't feel like we get that as much. Is that going to come back at any point?
It probably will come back, but I would say those blockbuster events, I mean, right now we are in September. Usually this would be end of summer sales events, model year sales down. Those are probably things that you remember. That doesn't have to happen because there's just no inventory to sell down at this point in time. I do think that inventory will get better. Will it be as much as it once was, where there's just tons of options on every dealer and every dealer is trying to undercut another dealer? I don't know if we're going to get to that. That seemed to be maybe an unhealthy place, but I think it'll be somewhat in the middle. I mean, right now the inventory is far too few, but to go back to those days where it's just the discounts were so heavy, I don't know if we'll exactly get back there.
The new car dealers I talk to love this dynamic. Low inventory, high prices, lower employees. What's going to change this dynamic, and how essential is it for the Fed's fight against inflation?
Yes. So I think for car dealers, this has been a good time. They've got high margins. They're not having to sell as many vehicles. They're not having to just work on volumes, which is a really stressful business of trying to make your number at the end of the month and all of that goes with it. But I think moving forward, there's just not enough vehicles for consumers, and that is an issue because consumers are walking to a different brand. They're trying to figure out if another car is going to work for them because either they don't want to pay the higher prices or they don't want to wait, because that's a new thing too. Americans, we don't want to wait for our goods. We want them today, right now, and that is not happening either. So I think that this is probably not the system that is exactly ideal. So we probably are just going to have to keep, I would say, adding to the inventory, get it back to a normal level where it's not as if you're going to lose customers, because that really is the danger for auto companies as well as dealers, is they're just going to walk because someone else can offer them a car in 3 weeks and maybe at MSRP versus waiting 2 months and a few $1,000s over MSRP.
Jessica, how much of this is because of when we talk about the increase in cost here, how much of it is because of the supply chain aspect of it, the fact that suppliers are raising their costs and therefore some of these automakers are being forced to pass that along to the consumer?
Yeah, I mean, there's probably a few dynamics going in. One is consumer driven. Over the years, people, especially in this country, we've wanted larger vehicles. We want more options. As a result, a lot of companies, especially Detroit companies, they shuttered their smaller car lines. So that has naturally driven the price of vehicles up. And then we hit this supply shortage, mostly led by the semiconductors, which has made inventory really scarce. And I think that is what really has propelled these prices that we see above MSRP or at MSRP, and it's a little more atypical than what we've seen in the past. This industry has never seen an issue where not having enough inventory is the problem. It's usually just sluggish consumer demand, and that of course is not the case. But a part of these rising prices has been our own tastes. We like nice things. I think that's fairly typical of what we see when we look at cars around.
And so what are some of the trends that you're seeing in the leasing versus buying decision making?
Mm-hmm. Right now, the leasing market has really taken a hit. People are not necessarily as interested in leasing. A lot of leasing relies to get those low monthly payments that you've seen, the $499, $399 a month. It relies on automaker incentives, either subsidizing the interest rate or the residual value. Automakers haven't had to do that right now because inventory is so tight and people will just buy them outright. So as a result, the leasing deals aren't really good for consumers out there. So they're not leasing. Even brands that are normally leased at such high rates, like the luxuries like Audi or BMW, even those guys are not leasing very many vehicles because it just comes down to what just makes more sense. If you're going to pay such a high price, I'm just going to buy the vehicle.
Electric vehicles, stunning national average transaction of 61,955. Given gas prices are continually falling down and recessionary fears, what's likely to drive that supply back up, and what is the pricing action? Where are we headed with EVs?
Yeah, I mean, the biggest issue with EVs is that automakers can't make enough of them. I mean, there's virtually waiting lists for nearly every EV on the market. I mean, some EVs like the Ford F-150 Lightning are so popular, I don't even think you can get on a wait list right now. You have to wait till the next model year comes out. So the issue, I think, is really supply. Of course, having a transaction price over 60,000 is not going to be the end goal for a lot of automakers. That is out of reach for a lot of American consumers. So the goal is to bring down the price in terms of product, really. So introducing less expensive vehicles like we saw a few weeks ago at the Detroit Auto Show with the Chevy Equinox EV. That will be here. That's promised at $30,000. So I think for this market really to grow, the vehicles have to come down in cost, but it is a bit of a catch because the supply is so short, and it's going to be short because of some of the commodity issues that automakers are facing to build these vehicles.
Jessica, we did get news today. The Department of Transportation here approving the electric vehicle charging station plans for all 50 states. We know President Biden and his administration has been very ambitious in some of their EV goals. I guess, to what extent does this really move the needle?
It definitely does, because I think with EVs, it's sort of a chicken and egg. It's like, do people buy them first without charging, or chargers built first and then people will buy them? So there always has been a lot of confusion, but what we know is that these two markets have to move in parallel. People are going to buy EVs at high rates. California, for instance, saying that they're banning ICE sales by 2035. These charging stations are going to have to happen. And Americans do buy cars on the notion that they are going to drive one day across the country, even if we never do. So having that national infrastructure of charging is extremely important for people to make EVs their sole vehicle. Because right now we see EVs as a second or third vehicle, but to make it that person's only vehicle, this is going to happen. So I think a lot of things have to happen in this market for people to feel comfortable, but infrastructure is obviously a very crucial one.
Certainly is. All right, Jessica Caldwell of Edmunds, thanks so much for joining us. Well, in the meantime, take a look at shares of Ford. You can see just under pressure today. Now the automaker announcing it will invest $700 million in a Kentucky truck plant and add 500 jobs. This is in an effort to support production of his 2023 model year F-Series Super Duty truck. Now, this is the first wholesale redesign of this truck since 2017. It also shows that even as Ford is investing and betting big on EVs, the automaker is still staying true to its roots with its trucks. I will be sitting down with Ford CEO Jim Farley, and you, of course, will be able to watch the interview tomorrow right here on Yahoo Finance.
Looking forward to that, my friend. Ahead, new data shows home prices in Miami are still on fire despite rising interest rates. One of Miami's top brokers joining us next to explain why. Housing prices cooling across the country as the Fed chair seeks a, quote, difficult correction to bring supply and demand back into balance. But there are exceptions to that rule, notably South Florida. That's where you'll find Dora Puig, principal broker and founder of Luke's Living Realty. Dora has over $4 billion in career sales. Nice to see you. So this morning we get new data from the Case-Shiller Index showing Miami prices up 32% year over year. What are you seeing in the Miami market?
I'm seeing a little bit of a slowdown over the summer, but this is typical of our market because of the seasonality. It was low season for the first time in 3 years since the pandemic. So everyone went to travel. Travel bans were lifted, no masks. So we were back to our low season, but we've definitely seen an uptick in traffic in the last 2 weeks as we're getting ready to start our high season again.
Redfin showed us some numbers earlier that luxury market across the country down 28%. That's the largest they've ever seen on record and far outpacing the lower level. You deal with primarily the luxury market in Miami. Are you seeing a dramatic impact of mortgage rates double where they were from a year ago?
I'm seeing a bit of an impact in the $5 million market and under. That's typically the buyer that needs a mortgage. We're starting to see prices drop a little bit and inventory creep up a little bit in that market because I believe that market is the market that's getting most affected in Miami-Dade County, where I work, in the $1 million+ market. In the high end, when I start to think of $6 million+ market, it's typically cash deals, and I don't believe they're going to be as affected. Our trophy residential market, I think, will absolutely not be touched, and that would be north of $20 million.
The Citadel CEO, Ken Griffin, recently moved his company to Miami from Chicago. Who are the buyers? Are you seeing potential people move from New York, from Chicago? Are they moving from within? Are they international? If you could paint a picture of the typical luxury buyer there in Miami.
The luxury buyer, I always say, has been good old USA, red, white, and blue since 2015. This has been New York, Chicago, California, all the winter climates, lots of Toronto and Canada. I've seen the international market's been very light because the dollar's been so strong overseas. We're still seeing a huge influx of New York, New Jersey, and the Northeast corridor, consistently purchasing in our luxury residential market. I think Ken Griffin's Citadel move, which is slowly starting to flicker in, is going to be a huge buffer for our luxury market. So if all these interest rate hikes and the conversation about a more narrow landing to recession does hit Miami-Dade County, I think 1,000 families moving to South Florida from Citadel is going to be a huge buffer for our luxury market.
He himself threw down $100 million on, I think, the biggest purchase there. The people who might come from Citadel and some of the people you mentioned earlier really invest in the market. Are you seeing a pullback in buyers because of where the stock market has gone in recent weeks? And are you also seeing fewer real estate investors that really drove those prices up?
We've predominantly been in an end user market. It hasn't been a huge investment market in the residential business. Maybe commercial's seen a lot of investors, commercial real estate. Residential here is really end users, turnkey, move in. They're worried about schools. They're worried about location and area. That they're going to live here. So I don't believe it's so much investment as we used to see in the old days with the Latin Americans. Ken Griffin's going to be moving also possibly to Star Island, where he bought a 4.5, 5 lot parcel to build a home. So all of these Citadel people that are starting to flicker in are pretty much the top end of the market. I haven't seen yet the lower end start to create sales because of his move. There are also a huge amount of other investment banks coming, Goldman Sachs, the Apollo Group. All of them are opening offices between Palm Beach and Miami-Dade County.
all attracted to those tax rates. The inventory has been the real backstop nationwide that prevents a big crash in prices. What's the inventory story in Miami?
Well, we're still very, very low on luxury residential inventory, which is what I think is going to give us a huge buffer this winter. When we start our high season, November 1st, November 15th, I expect all of the luxury inventory that's kind of coming out in the market right now to get absorbed. So I'm still bullish on Miami. I don't believe it's going to be a total frenzy as it was the last 20 months, but I do believe we're going to have a very solid winter selling season.
Yeah, that type of frenzy is certainly unsustainable even for Miami. Dora Puig, great to have you on Yahoo Finance. Thanks so much. Appreciate it.
Thank you. Great to see you, Dave.
All right, coming up, Intel introducing its newest line of chips. Find out what it means for the ongoing battle with AMD when we come back.
It has been a brutal time for semiconductors. Those chip stocks have taken a huge hit as rates rise. We know that, of course, is a huge headwind here for some of the biggest names within the sector. NVIDIA, of course, bouncing off its 52-week low, off just around 23% in the past month. AMD has also been under a tremendous amount of pressure, dropping more than 26% in the past month. Competitor Intel, not too far behind, off nearly 20%. But Intel is trying to turn things around. The company debuting its new 13th Gen Core processors today. Yahoo Finance's Dan Halley joins us with those details. Dan, what can you tell us?
That's right, Shauna. They introduced their new 13th generation Intel Core processors today. These chips, they say, top out with its i9 processor. They say it's the most powerful computer processor in the world, at least as far as the standard home processors go. I'm sure there's bigger ones out there in supercomputers, but this is supposed to be one of the ways that the company is trying to wrestle back control of the market from the likes of AMD, as well as competitors like Qualcomm, which are increasingly pushing their way into the PC market. The event here, Intel Innovation, focused, though, primarily on what developers can bring to Intel and how they can help expand the company's value. They used to have an Intel Developer Forum conference. This now is taking place of that. And this is something that Pat Gelsinger pushed on stage during his keynote, basically talking about how developers will help push Intel into the future, not just its silicon. One of the big showcases that they had was, believe it or not, some of the vision technologies that they have using the likes of Chipotle as an example, how AI vision computing can be used to help restaurants see what kind of products they have that are running low and then quickly put them back into place. There was a really interesting demonstration that Pat Gelsinger was showing, grabbing salsa verde out of this case that was supposed to be a simulation of what a Chipotle bar would look like, and then really quickly having the AI being able to say, look, you're running low on this particular product, you have to refill it. So they're really pushing forward with this developer aspect of things and hoping that that gets them back to where they were. Obviously, Intel had a very, very rough Q2. Q3 also could be problematic, and we're looking at that, as you said, because the PC market itself really starting to fall flat, although we've seen servers kind of holding up on their side of things.
Indeed. Intel pushing ahead, though, by the sounds of things. Great to have you on. Dan Howley, thank you for joining us this afternoon. All right, well, coming up, we're counting down to the closing bell on Wall Street. Stick with us on Yahoo Finance Live.
All right, we are just minutes away from the closing bell. Now let's bring in Yahoo Finance's Jared Billick to break down all the market action and see if we can rally towards the close. Jared?
Yeah, looks like we got the Nasdaq barely in the green, but that doesn't count for much, does it, when we are breaking news? Still in a bear market. I guess that is actually not breaking news. Here are the Nasdaq futures, so we can see the AM action as well overnight, but we have descended into bear market territory a few times today, probably closing around that level. Want to get to the heat map action. Here's the sector action for today. We got a mixed board. Energy in the forefront. There's some speculation that OPEC Plus at its next meeting may announce some production cuts. We'll have to see what comes of that. But mostly things are in the red here, although we do see the defensive sectors more in the red. So it could be a ray of sunshine there. Here are our leaders. We have TAN, that is a solar ETF, followed by ARK, cannabis, meme stock, IPOs, all of those outperforming. Throw transports and biotech in there too. Not a bad look today. I do like to check in on travel as we approach that closing bell. Carnival, Royal Caribbean, Royal Caribbean, and Airbnb. All of those in the green for more than 3% today.
All right, stocks ending the day mixed. You can see the Nasdaq holding on to gains. I guess a sliver of hope in this market sell-off that we have been dealing with for the past several trading days. Nasdaq closing up just around 0.25%. S&P and Nasdaq, though, in the red once again. S&P off just around 0.2%. Dow closing off its lows of the day is still off 123 points. All right. For more on today's broader market action, let's bring in our guest. We have Michael Kushma. He is a Morgan Stanley Investment Management Chief Investment Officer of Broad Markets for the Fixed Income team. And we have Jas Thandi, AM Partner of Portfolio Strategy. Michael, let me start with you just in terms of the action that we've been seeing play out in the bond market, because that, of course, has been driving the moves that we've been seeing in equities. We have the 10-year yield continuing that march higher, not too far from 4%. The spike that we've seen in the 2-year. What's your takeaway from that action?
I think what we're seeing is the market throwing in the towel that the Fed is serious about raising interest rates as far as necessary in order to beat down inflation. And this month's FOMC meeting, while on the face of it seemed like they did exactly what everyone thought they'd do, raising rates 75 basis points. But what they did do was raise their expectation that the terminal rate, the final highest yielding Fed funds rate, would be 4 3/4, almost 100 basis points from where previously they had estimated. And the market is embracing that in the sense that it's a reasonable expectation given the Fed's commitment to reducing inflation.
And Jas, we heard from Fed Chair Powell, look, he's saying, I'm going to be looking at 3-month, 6-month, 12-month views when I'm looking at this thing. But the markets, though, seem to react to every single data point that comes out. How should they be digesting the messaging from the Fed versus what they're hearing from these data points that come out?
I think it's the data. I think the Fed's made it clear they're going to be data dependent and drive their views through data. So I think the data will drive volatility going forward. What we've seen is any bit of news, yields react, and therefore stock markets react. When we look forwards, this next week is going to be a big week. We've got GDP coming up, confidence numbers, next week income numbers, and all of that is going to drive future volatility, because that is what is ultimately going to dictate the Fed's path. As Michael mentioned, markets more realistic now in their pricing, but I think it's markets really don't know how far, how fast, and how the Fed does it because we haven't been in this environment before. So we expect the volatility to continue.
Michael, if the markets are throwing in the towel, how long do they stay on the mat, and what gets them up off of it?
Well, I think we have to see some change in economic performance. So up till now, the labor markets have been rock solid, and the Fed believes, as most market analysts believe, that wages drive inflation in the medium term, with U.S. labor markets staying very tight, wages rising 6 to 8%, depending upon what you look at. There's very little to be optimistic about that inflation will drop back to the 2% level anytime soon. So the key factor is what will drive consumers' spending down, what will drive consumption down, what will make the labor market loosen up a bit. Then market will say, maybe rates have finally reached their peak.
Jas, when you're trying to look for any good news here in this market, can you find something for us?
I think it's really going to. I think we could end up in a world where bad news becomes good news, right? What we've had now is good news is bad news because the Fed has to continue to tighten. But I think it's really going to come down to seeing some of that economic numbers roll over. I think it is slightly comforting. We have seen some of the kind of growthier sectors perform okay today, but I see that battle continuing. I don't see much out there. I think there could actually be more bad news based on what's going on with earnings right now and how that's looking at the expectations for next year, which are close to 9% earnings growth year on year for next year, which seems that it could be an at-risk number for next year.
And Michael, what do you think is the best way to position your portfolio when you do have this environment and when you have the Fed looking at inflation and then also perhaps with that lag now, of course, with the real economy data behind it?
That's a very, very good point. That the stuff that we're looking at, the labor market, consumption spending, consumer confidence, some of this stuff is lagging. It's looking backwards. And the danger, of course, is that the Fed keeps its eyes on the backward-looking data, the lagging data, and raises rates too far. So the danger is the Fed keeps going when they shouldn't keep going because the labor market responds with a lag. Next year's wage settlements, wage growth is probably dependent on what happened this year, not so much what people think is going to happen the next 12 months. So I think in terms of what we're positioning is valuations are getting better in the bond market. We haven't seen yields like this in a long, long time. As we saw, the 10-year Treasury is closing in on 4%. Cash rates are 4%. I think it's a bit premature to get too optimistic that we're seeing the peak in yields, whether it's an investment grade credit or U.S. Treasuries or other high quality bonds. But we're getting to the point where on a longer term horizon, looking out toward the end of next year, yields are getting to levels which look like okay. In other words, they're high enough to weather future volatility. But in the very short term, meaning now to the next couple of months, we think staying conservative, shorter maturity assets, short rates may have peaked. Even if they haven't peaked, they're not likely to rise by only a fraction what they've risen recently. So it's all looking a little bit better in terms of getting enough income, which is what fixed income is about, in order to protect you from any uncertainties and volatility in the future.
And Jas, we'll tag you in on a strategy with all these headwinds. You recommend investors build resilience in their portfolio. How so?
Yeah, so for us, with our clients, it's really looking at things that are backed by things like real assets, like real estate, some kind of infrastructure funds based on the Inflation Reduction Act spending that's going on. And this is all about really insulating yourselves from the possibility of the equity bond correlations becoming more positive now on a more permanent basis. So for us, it's really about adding those assets that have less correlation to those two main bellwethers of portfolios to create that diversification for our portfolios.
All right, Jas Tandy and Michael Kushma, appreciate you both being here and weighing in on this tough environment. Have a good one. Ahead, airline workers across the country picketing for better pay and safer work conditions. A leader in the union representing flight attendants joining us with their argument next. Southwest flight attendants are picketing across the country today as their union negotiates a new contract with the airline. For more on this story, we're joined by the president of that union, Lynn Montgomery, of the Transport Workers Union Local 556, which represents the airline's more than 18,000 flight attendants. Nice to see you. And a statement you say never before in the history of Southwest have working conditions deteriorated so rapidly. What changed for flight attendants in the last couple of years?
Well, the last couple of years have been extraordinarily difficult for flight attendants at Southwest Airlines. And actually, some of these issues existed even before the last couple of years, which I'll call the pandemic years. But we have had to work long, exhausting hours. We're having to sit on call 24 hours, which is causing some of our flight attendants to stay up 24 hours. We have been just the victims, along with our passengers, of horrific technological failures that have created chaos throughout our personal lives and our daily work schedules. And we're just really needing to see some changes.
Lynn, what are some of those horrific technological failures that you just mentioned?
Yeah, so the company has experienced technological breakdowns large enough to impact nationwide flights nationwide, where flight attendants have had to wait for hours on end just to find out what their next assignment was, or when they would be going to a hotel, or where their hotel was. I mean, we have reports of flight attendants having to wait 3 to 4 hours on hold with crew scheduling for their assignments and hotel reservations.
And I understand there's been a number of delays during this negotiation process. How has that affected your ability to really negotiate?
Well, unfortunately, the negotiations have not been going productively or fruitfully. So we have filed for mediation, and we'll be meeting with a mediator in November with the company and a federal mediator, because we haven't found that the talks have been progressing at all.
Specifically, what is the number one thing you and your fellow flight attendants need from Southwest at this moment?
Well, we really need Southwest Airlines to understand that that we can't be saying sorry anymore with all these technological breakdowns. We need quality of life changes, and we need to be paid for all of our hours worked.
In terms of the pay incentive, there obviously a very critical part, very important part of this contract that you're trying to negotiate with Southwest. I guess more specifically, are you looking for an increase in terms of salaries for what you're already working, or just those additional hours?
You know, increase in pay is always something that's on the table, but we are actually looking for a lot of quality of life issues. You know, when Southwest Airlines has these operational breakdowns, or you are delayed because of weather, it's really having an impact on flight attendants' lives. And we're not seeing pay for that overtime that we have to put in if we have to stay a few hours, or many hours after our shift, or even working extra days. We're not actually seeing that pay as good as we should be seeing it.
And what about some of the benefits that you're also looking at in terms of things like better health benefits?
Well, one of the most tragic things I think that can happen to a Southwest Airlines flight attendant is when she or he gets injured in the line of duty. You can actually lose your flight benefits while you're out on the job injury leave. And that's just really despicable when you have been working in the line of duty and you get injured. We also want to be able to see that flight attendants can retire. And we also want to see that if you are having a need to stay home with your children, or need to breastfeed, that you're given the time to be able to do so without losing your health benefits.
And just to be clear, you are not striking. Are you willing to strike? And one of the most recent changes in the last several months has been alcohol has returned to airplane flights. How has that changed working conditions for flight attendants?
Well, initially when the alcohol returned, we were still under the mask mandate. And that was really the difficulty there, because flight attendants were having to govern the wearing of the masks. And that really generated a hostility on board the aircraft. And flight attendants ended up having to be the victims of many assaults and aggressions from people who were upset that they were required to wear a mask.
Lynn, what has the response from Southwest been? Have they been open to some of the changes that you and other flight attendants that you're representing want to make?
Southwest Airlines really doesn't want us to ask for as much change as we need to see. They've been asking us to narrow our scope. Unfortunately, the flight attendants contract really hasn't changed significantly since 2009, but our operation has changed dramatically. So we really need to see a contract that steps up and stays in line with the operation that we have today.
So I want to ask you, obviously, about hiring. A lot of people seeing this news, seeing the moves coming from Southwest. What is this doing in terms of the new hire pipeline? How is the union addressing that?
So the company is hiring quite a lot. We actually meet with new hires while they're still in class, and we have a new hire committee where we reach out and talk to them. And I have to tell you, it's a little disheartening because many of the new hire flight attendants that are coming to Southwest Airlines are feeling the impact of the exhaustion after a long day because of the way that our duty days work and the way that we are scheduled. And they are quite surprised by that. And some are considering leaving.
Goodness. Well, we certainly hope that's not the case. We thank you for what you are doing. Transportation Workers Union Local 556 President Lynn Montgomery. Well, we reached out to Southwest for comment, and they had this to say. Southwest Airlines has an award-winning culture that respects our employees and encourages them to express their opinions. Southwest looks forward to continuing negotiations with TWU 556 and the National Mediation Board so that we can reward our flight attendants and continue attracting great talent. We certainly hope there is a middle ground that can be reached there. Well, Fed Chair Jerome Powell weighing in on a central bank digital currency. Our next guest tells us why a move towards a digital economy is inevitable when we come back.
Leadership changes coming to two crypto firms today. David Hollerith here with all the details. David, what are we learning?
Dave, Alex Mashinsky, co-founder and CEO of the bankrupt crypto lender Celsius Network, resigned this morning. He said in his statement that he regrets his continued role as CEO has become and an increasing distraction, and that he's very sorry about the difficult financial circumstances facing Celsius customers. Now, prior to his resignation, in his leadership position, Mashinsky had become a key focus for the bankruptcy proceeding, with dozens of customers turned unsecured creditors, alleging that his public statements around the business's health misled them. Now, added to that, the industry insiders have also issued lawsuits and reports that have shared claims suggesting that Mashinsky also manipulated the price of Celsius's token for his own personal gain. On a slightly better, or I guess we could say lighter note, Brett Harrison, president of FTX US, the US operating subsidiary of crypto exchange FTX, is also stepping down as of today. Harrison announced this over Twitter, and with the change, he is becoming an advisor to FTX US, having cited his desire to work as a financial technologist and yet remain in the sector. In a related change, FTX US will also move its office to Miami, Florida. And as to whether there will be another president for FTX US, the company has not yet made it clear.
A lot of crypto action down there in Miami, isn't there? Meanwhile, Microsoft also led a big funding round for a Web3 data startup. What can you tell us?
Yeah, today Microsoft's venture arm M12 led a $20 million strategic funding round for a decentralized data storage startup called Space-Time. Now, this is sort of an infrastructure firm that specializes in what you would think is the crypto version of cloud data. And its aim is to sort of make that data more accessible to not only companies that aren't working in the crypto space, but also just companies in general working in the space who want to have more efficient access. Now, as part of the round, Space and Time will integrate with Microsoft Azure, which will give Azure customers an on-ramp to blockchain native data, according to the release. Generally speaking, though, venture obviously has slipped for the sector this year compared to last year's bull market. But this year, the trend has been that VC firms have been eyeing early stage startups with a focus on crypto infrastructure companies such as this.
Okay, David Hollerith with the very latest for us on these changes. Rochelle, over to you.
All right, thanks, Dave. Well, central bank digital currencies, or CBDC, in focus once again today, as Federal Reserve Chair Jerome Powell says there's a real need for improved crypto regulation. That happened during a panel hosted by the Banque de France. We're here to break down the current landscape surrounding CBDCs is Jonathan McCollum, Davidoff Hutcher, Citron Chair of Federal Government Relations. Good to have you on the show. So a lot of people wondering, we'll take a step back here, because obviously you have cryptocurrencies, you have stable coins, and then you have CBDC. How do the regulations differ with these?
Yeah, so it's interesting. The White House just issued a digital asset report, a comprehensive framework that came out where it touches on several of these aspects. The White House called on federal agencies to look into crypto assets, also explore central bank digital currency and the benefits and risks associated with those, and then also asks agencies to provide more clarity and guidance for cryptocurrency companies here in the U.S. As they move forward. As we're looking at central bank digital currencies, there are hundreds, over 100 countries currently exploring in the exploration phase of launching a CBDC. I think that, there are a lot of reasons for the U.S. to get involved, to maintain its status as a global reserve currency and to promote American values as the CBDCs start to pop up more around the country.
Because as we look at some of the countries leading the way when it comes to CBDCs, obviously China leading the way, how far behind, though, is the U.S. in really getting that off the ground?
I think we're about 4 or 5 years away from, being fully operational. But it's important to start now. And I think that the White House and Department of Treasury and the Federal Reserve are in that process. They're still conducting research and have further some further reports that they're looking at on design, implementation techniques. But I think that the U.S. Will be moving forward here shortly.
And we know that Fed Chair Jerome Powell talked about the minimum criteria for a CBDC. The Fed has been tasked with some of this ongoing research that you were just mentioning. I want to have you take a listen to what he said about this criteria.
If we were to pursue a CBDC, it would at a minimum have the following 4 characteristics. First is intermediated. Second is privacy protected. But third is identity verified. So it would not be anonymous. It would not be an anonymous bearer instrument. And fourth is transferable or interoperable. So we would be looking to balance privacy protection with identity verification, which has to be done, of course, in today's traditional banking system.
Now, obviously, he was drawing comparisons to how the current financial system is governed, though. But as you talk about this 4 or 5 years, this is a multi-agency effort here, including the Treasury as well. How much red tape do you think we're going to have to go through at each stage to really actually get this off the ground?
Yeah, and Chairman Powell has said that he doesn't feel comfortable moving forward with the development of a CBDC without some congressional authorization for the Fed to do so. I know the Justice Department here in the U.S. is looking into that, the legalities, but I think it's important for kind of an all-of-government approach in order to move forward. A couple things that he touched on there, it's important for this to be an intermediated model and to run on existing bank payment rails. So this wouldn't be something where an individual consumer would have a credit or an account at the Federal Reserve. It would function through intermediaries, banks, community banks, payment providers, and then filter down to the consumer. He also touched on privacy, and I think that's a really important component to what we're looking at. Our current existing laws that we have on the books here in the U.S. really outline several areas of how cash should function. Should be printed and minted at the Department of Treasury. It then goes to the Federal Reserve, where it's a liability on its books, and then is distributed by the Federal Reserve out through existing channels, going to banks and then different payment providers from there. And I think that's the model that we need to follow. In fact, while there are certainly a lot of different agencies that are involved, the actual legislation that would be required or amendments to existing currency legislation is not all that complicated. And I know that there's folks on the House Financial Services Committee and the Senate Banking Committee that are currently working on some of those issues. And, again, as I said, I think it's important for the U.S. to get this process started and for the Treasury to really take the lead on, what the parameters need to be, and then rely on the private sector for different input. I think once the law is in place, it's going to allow the technology to develop to meet the law's requirements. The technology is somewhat flexible. What we need to do is make sure that we maintain a lot of the values that we have here in the U.S. in the way that our cash currently functions.
And we know that a lot of these issues surrounding consumer protection when it comes to digital assets really arose from the sell-off that we saw in crypto, and really, the government really wanting to get an understanding, because Bitcoin essentially developed because it was to address the unbanked, people who wanted decentralized financing. What sort of gap do you think CBDC will fill? And how do you see it relating to perhaps what we see happening with crypto markets?
Yeah, I think a digital dollar would make transactions faster and cheaper because it would be final and complete in real time. It also allows users to make payments to one another using risk-free assets. This is the same capability that we have, again, in the physical dollar today. It would just be in its digital form. I think cash is the most financially inclusive instrument that we have. And by allowing for CBDCs to be in place, it would allow folks that are currently unbanked to have access to a digital form of payment.
Well, I do thank you for joining us this afternoon. Jonathan McCollum, thank you so much. All right, coming up, a new survey reveals how many US employees are seeking additional hours to combat soaring inflation. Stay tuned for the results. The FDA announcing that it's limiting the number of emergency use authorization requests for COVID-19 tests that it will review. Now, Yahoo Finance's Anjali Kamlani is here with the latest. Anjali, I think the biggest question here is what this means for consumers who need those tests.
Well, Shauna, I think the important part to point out is that it's not taking these tests off the shelves. It's simply reducing the emergency use authorization, which was put in place, as you know, because of the pandemic. There are now more than 430 different tests out there, and clearly the supply is outstripping demand at this point in time. Of course, we've already talked about how there's an increase in purchases of these tests in the last few weeks. Probably that will continue, but companies are nowhere near where they were in terms of a lack of capacity to produce these. And so at this point in time, it's sort of the FDA pulling back and making sure that all the tests that are out there are actually good ones. There were some concerns earlier on that with the rush to get these to market and to get them in the hands of individuals who needed them, there was some possible quality concerns. And so this would help address that.
And Anjali, the pandemic highlighted some of these stark inequities that exist globally when it comes to the distribution of vaccines, treatments, and other resources. And the WHO began working on a legally binding treaty in 2021 that should have a full official draft next year. Now, you spoke to one of the contributors from the US. What did they have to say?
That's right. Georgetown Law's Larry Gostin caught up with me after coming back from a trip to Geneva and just gave me a little overview of what's going on there. And it's really interesting because, you know, there's so much discussion about the equity globally, but here in the U.S., it's kind of flying under the radar. And the really big impact on pharma companies is set to hit if this does, in fact, go through. Current draft looking at things like sharing of intellectual property and finding a way to solve that problem. That was really one of the biggest hiccups we saw saw in the equitable distribution. We also know that there's a focus on climate change as well, and pharma companies are in charge of some of these things like fertilizers, and so that really has a large impact on the sector. And as of right now, it seems like the discussion is still happening, but we do have to see how this all pans out and what this legally binding treaty is going to look like for these companies, what impact it could potentially have, and how we might be able to solve the problem in the future. So while things are still moving, the official draft looking to be ready by the end of 2023, according to a World Health Organization official. And so we'll wait to get more details on that. But as of right now, really building out to have a huge impact on the pharma sector.
Certainly a very important story there. Anjali Kamlani, thanks so much.
All right, inflation still near a 40-year high here in the United States. Everything we do, everything we eat, as you know, costs dramatically more these days. And as a result, we're all working more, or at least looking to work more, in order to make ends meet and maintain our lifestyles. And with that, a staggering number. Nearly 70% of Americans said they're seeking additional work to combat inflation. That's according to a new survey by Blue Crew, a workforce as a service platform. Also, nearly 6 in 10 Americans said they're currently looking for or are interested in short-term gig work. That is an astounding number. If you'd have told me that number was at 25 or 30%, I'd have said, Shauna, that is extraordinarily high. 70% of Americans gives you a real accurate picture of how difficult things are right now and why, perhaps, the Fed believes they have to do whatever they can to bring that inflation down, even that it means 1 million to 1.5 million people losing a job. CNN, in a separate survey with Bank of America, showed 70+% of people say inflation is eating up anything they're earning at work. They're not getting a quick enough raise. It is difficult.
It is very difficult. These numbers stuck out to me too. I also think it's even more concerning when you take into account what the Fed is trying to do as it tries to get inflation under control. More people, like you just said, could be out of a job. So if so many people are already feeling the financial strain right now, it could potentially get much, much worse here as the Fed does try to do all it can to rein in inflation. A couple of other numbers that stuck out to me here in that survey. 85% of Americans saying that inflation has impacted their recent spending and also their buying habits. I don't think that should come as a big surprise given the fact that so many are already looking for more hours or second jobs in order to deal with higher inflation. 72% saying that inflation has impacted the view of their job. 57% saying that they have sought out new or additional roles over the past year due to the rising cost of living. That just reaffirms the situation that millions of Americans are in right now, how it's so tough when you look at almost everything you buy on a daily basis has risen in price compared to last year. And Rochelle, taking a look at these numbers, so many Americans looking to add on hours, looking to take on a second job, really just paints the exact picture of the current economic picture right now.
No, it really does. And when you think of how we're trying to look at the labor picture, then when you have people working a job, but then also perhaps taking on some of these seasonal jobs, it might muddy the economic picture when you're trying to figure out how the labor market is actually doing. If there's 2 open jobs for one person, but people are then taking on a second job, obviously it makes it more difficult to calculate. And as we look at some of the things that people considered their priorities pre-pandemic versus now, wages and pay, 57% prioritize that. Work-life balance, though, right behind it at 56%. Then that even superseded benefits at 55%. And that even overtook things like schedule flexibility or enjoying what you do. And sadly, over prioritizing your mental health. So people really having to make some very tough decisions and making some really big sacrifices that hopefully don't end up becoming too costly. But it's obviously a very tough space for people right now.
It's a good reality check to know that you out there watching us, I'm right there with you. 70% that would work more or take on a side gig to pay the bills. I'm with you, friends. All right. If you're planning on flying for the holidays, don't wait until the last minute to get your tickets. Find out why after the break.
Walt Disney World reportedly will close all 4 of its Florida theme parks on Wednesday and Thursday due to expected severe weather from Hurricane Ian, which is currently forecasted to pass over central Florida. Now, the company had already announced it was going to close some properties Wednesday through Friday, including Disney's Fort Wilderness Resort Campground. In addition to Disney, Universal Orlando and also SeaWorld announced they will be closing for 2 days due to Ian. Dave Briggs, fresh off a plane from Orlando.
Yeah.
He took the trip just in time.
Yeah, got out just in time. We were a little bit worried about it. I know someone here at Yahoo was planning to be there all week, had to cancel. But I will tell you, being in Disney World and in Universal is a reminder that this is the weirdest recession we've ever seen, if in fact we are in a recession. Every park, every ride, everywhere you go, every restaurant is packed to the gills, beyond capacity in some cases. And not just that, it's $174 per ticket at Disney World, but it's the people that are paying to skip the lines and to get the lightning lane, as they call it. Every one of those is sold out and long lines waiting on those. This is a strange time in which either we are not in a recession, people saved up and they're just still getting that post-pandemic travel out there, or Disney World and parks like Universal are 100% completely recession-proof. I'm not sure which is the case.
Yeah.
But it was
It's
stunning
expensive.
to me.
Yeah, that is stunning. I was surprised. I actually thought that you were going at a good time since it was right after school started. I didn't think it was going to be that crowded. I thought you guys played it right. So you played it right weather-wise. But I guess it could have, maybe it could have been much more crowded if you hit it during some of those prime spots. But that's interesting.
Times are good.
Be interesting to
down
see
there.
whether or not that attendance holds up if we do see more of a severe downturn in the economy. All right, well, speaking of traveling, millions are getting ready to hit the skies this holiday season. And if you're one of those travelers, you better get ready to pay more. Flights this holiday season are expected to be at the highest levels that we've seen in 5 years. For more on that, we want to bring in Haley Berg, Hopper's lead economist. Haley, it's great to see you again. So I guess first, how many people are expected to travel and how much more should people be prepared to pay this year?
We're expecting to see a huge surge in travel over this holiday season. Keep in mind that in 2020 and in 2021, we saw huge depression in travel demand at the holidays. We had the active pandemic in 2020, and then last year we saw the Delta and the Omicron waves knock out thousands of flights over the holiday season. So we know that travelers have pent up demand for holiday travel, traditions, visiting family, vacations, and we're expecting to see a very busy holiday season. And with that super high demand, we're expecting to see the highest prices, especially for Christmas, that we've seen in more than 5 years.
Haley, if you're trying to determine when is the best time to fly, any tips there?
Absolutely. If you're traveling for Thanksgiving, your best bet is to travel on Monday before Thanksgiving or Thanksgiving Day if you can. Do not try to fly home on that weekend after Thanksgiving. Those will be the busiest airports and the highest prices. With Christmas over a weekend, we're expecting to see a lot of travel dispersed across the days before. So as early as you can travel for the holidays in December, the better off you are in terms of price, but also availability of flights. Capacity is lower this year than it was in 2019. So flights will sell out, and they will sell out early.
And Haley, what are you seeing in terms of what people are willing to spend depending on where they're flying to, whether it's domestic or international?
Mm-hmm. We're seeing right now that airfare for Christmas, for example, is already at about $440 per domestic ticket. International fares over $1,200. And we're expecting those prices to rise as we get closer to the holidays. Unfortunately, something coming out of the pandemic is travelers are planning travel more last minute. And that means it's harder to find deals. If you're not planning far in advance, using a price monitoring tool, it's harder to find those one-time price drops or sales that are going to help you get a great deal. So we're expecting that travelers who are planning ahead, either for Thanksgiving or Christmas, they're going to be paying between $300 and $450 for their holiday travel. But those last minute travelers, we're expecting to see prices well over $500 for Christmas and well over $400 for Thanksgiving.
So Haley, how do we use these price monitoring tools you just referred to?
So using a tool like Hopper, where you put in the destination that you're going to and the dates you're traveling, and getting proactive notifications about your trip and the price, that's the best way to take advantage of deals. So we're going to do the hard work for you. We're going to be checking the price at 4 a.m. on Saturday and 2 p.m. on Tuesday, every single day, and notifying you what the best price is. Is it available now? Should you book now? That is key. We see at Hopper that travelers who start planning their holiday vacations around now or even earlier will save about 18% more than those who plan very last minute. With prices high this year, that's $80 per ticket or more just by planning ahead and using a price monitoring tool. So download an app like Hopper, get those live updates, and hopefully you will see significant savings for Thanksgiving, Christmas, New Year's, whatever travel you're planning next.
Now, it's interesting because you say, obviously, the last minute bookings for flights, that's a big no-no, but not the case for hotels. Why the difference there?
Yes, this is a little bit of a confusing one for travelers who know don't book your flight last minute. Hotels are very different. So when you're going to a big city, think New York City, Los Angeles, those cities have a tremendous amount of inventory, rooms available to book. So it's harder to sell out a city like New York City, especially over the holidays. If you're planning to go to one of those big cities, booking at the last minute, you're going to get those price drops that hotels put out there to try to fill the rest of their rooms and probably get a really great deal. So if you're going somewhere big with a lot of hotel inventory, you can wait until the last minute to book your hotel as long as you're flexible on where you stay. The specific hotel you want to stay at may be sold out. So if you can be a bit flexible booking at the last minute, if you are going to a vacation destination, anywhere in Florida, anywhere with a lot of resorts, book those in advance. Those will sell out.
And most of the time at the holidays, we're traveling to a predetermined destination to see family. But if we're not, if we're just looking to get away and to go somewhere warm, how do we find like a great deal if we are, to your word, if we're flexible?
Mm-hmm. Flexibility is key. It's the best way to get a good price. So using a price monitoring tool is another way that you can see all of the best options available to you. So on Hopper, for example, you can track the price of many different destinations. Say you're interested in a Caribbean getaway. You can track all of the different islands you might be interested in visiting and get live updates of what's the price of this destination versus this one. You know, if you travel a few days later, can you get a better price and go to the same island? So we'll do that work for you. But typically over the holidays, we see that international destinations often have sales or lower prices, given most people are going to that set hometown destination over the holidays. So flexibility is key, but let an app like Hopper do the work for you so that you're not browsing and looking up prices, constantly trying to figure out where's the best destination at the lowest price. That's what our price monitoring and watching does for you.
Haley Berg, Hopper lead economist. Thanks for being here. Appreciate it. All right, let's get over to Shauna with what is moving after hours.
All right, Dave, a couple of big names here. Let's start with what we're seeing from the big banks. Goldman Sachs, Citi, Bank of America, Morgan Stanley, among 16 firms that have reached an agreement with the SEC. They're going to pay regulators $1.1 billion in penalties for failing to monitor employees' use of unauthorized messaging apps. And we know it has been a tough go at it for some of the big banks, at least over the past month in this rising rate environment. Also fears of an economic slowdown. You can see Goldman Sachs off just around 13% in the past month. The Citi down just over 14%. Bank of America off about 10%. And Morgan Stanley, the best of the bunch over the past month, off just around 8.5%. All right, let's take a look at Meta because it was Sheryl Sandberg's last day at headquarters. She got a send-off from a number of her employees, thanking her for the job that she has done for the company over the last several years. She announced back on June 1st that she was stepping down as COO. It has certainly been a rough year for Meta as the company transitions its focus to the metaverse. Year to date, taking a look at that stock, off just around 60% today, right around 52-week lows at 134.40. Let's round it out with MindMed, a huge performer here, or underperformer, I should say, in after hours. Some news here announcing a proposed public offering of common shares, offering those subject to market conditions. We're seeing that stock tank after hours. And of course, just taking a look at a year-to-date chart, it's been a rough go at it for this company, off just around 70%. But even in just the last 3 months, we have seen this biopharma company under a tremendous amount of pressure, off just around 43%. All right, Taco Bell bringing back either the double-decker taco or the enchilada, and you've got to decide which one it is. We've got the details for you right after the break.
Chipotle's tortilla-making robot Chippy is graduating to a real restaurant in October. Chippy will be making tortilla chips in a Fountain Valley, California store. Now, feedback from staff and customers will determine a possible national rollout. And Chippy won't be the only bot in the kitchen. Chipotle is testing AI at 8 California locations that tell staff when to cook based on forecasts of how much of each item the restaurant may need that day. Now, Chipotle's plan for all of these tech innovations is to help staff and customers amid labor shortages. Now, this is an interesting one because a lot of times you think, is automation going to take some of these jobs away from people? But then on the other hand, if it frees them up to perhaps really enjoy customer service, like talking to customers, really making the dining experience better, I'm not mad at it.
Yeah, I think the automation angle has really changed with the way the labor market is right now. You're seeing a shortage across the country in all sorts of restaurants. So it's not really taking away jobs when most of these restaurants at all levels cannot hire enough employees. But their chips are good, so hopefully Chippy does a nice job. Rival Mexican restaurant Taco Bell allowing fans to choose which former menu item will return for a limited time. Brooke DePalma here with the details. Tell me it's those cinnamon Crispas. Tell me it's those cinnamon chips.
I am so sorry, but it is neither of those. Reward members actually can only choose between the double-decker taco or the enchilada. So this starts today. Reward members can go on the app and choose. Now, a double-decker taco was introduced in 1995 as a limited time offering, reintroduced in 2006. The enchilada had a longer run, a 40-year run. It hit the menu in 1970, left the menu in 2013. This comes after the mega success of the limited time offering, the Mexican pizza, earlier this year. Yum Brand's CEO noting that demand for the Mexican pizza was 7 times previous levels, reaching over 20 million pizzas sold nationwide, with some stores selling out within a week, creating a sustained positive halo for the brand. So perhaps Taco Bell allowing members to choose which one will become a permanent menu item. This ends October 7th, and then menus at participating locations will have the chosen winner later on this year.
Well, I was really hoping for the pizza, but both of those options sound good to me. All right, Brooke, Taco Bell is not the only one that's trying to cash in on this nostalgia craze. We got news out from McDonald's. They're trying to sell Happy Meals to adults. What can you tell us?
That's right. So these are Happy Meal inspired, but they're adult meals here. Of course, Happy Meal coming out of 1979. So McDonald's really trying to hit nostalgia as well here. This is in a collaboration with the streetwear brand Cactus Plant Flea Market. So this is a new boxed meal they're calling. It's designed specifically for adult fans. So starting October 3rd, the box will be available in restaurants, drive-thrus, by delivery, or on the McDonald's app while supplies last. Now, customers can choose between a Big Mac or a 10-piece chicken nugget to go into this box. And of course, what they coined alongside their world famous fries. But here's the catch here. This is in collaboration with that Cactus Plant Flea. So it will also come with one of 4 collectible figurines. The true nostalgic part here, it'll include either Grimace, the Hamburglar, Birdie, or a newcomer, the Cactus Buddy, of course, playing on Cactus Plant Flea Market's name. Now, along with this launch, there'll also be merchandise available. Of course, we see McDonald's try this earlier this year with their Szechuan sauce. They also recently unveiled the cheese Danish. So really looking to tap into Gen Z and capture that nostalgia as well. But I have to ask, are any of you planning to stand by October 3rd and get this drop?
Yeah, buddy. The
Why
Hamburglar
not?
is awesome.
I
love
like
the
it.
Hamburglar.
It's important to hear that this flea market also teamed up with Ye, Kanye West, of course. Yeah. They also collaborated with Supreme, Nike. So these do sell out fast. So if you're planning on it, be sure to log in October 3rd for sure.
All right, thank you, Brooke DePalma there. Thanks so much. This is fantastic. I already like a good Happy Meal because I like the portion size, but they got these like giant Big Macs and too many nuggets. That might be a lot of food for you, but I love the nostalgia. I do love the little toys that come with it. I will
Never enough food, Rochelle. Never enough.
Well, that will do it for today's Yahoo Finance Live. But of course, be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the bell. From Dave, Shauna, and myself, have a good one. Bye-bye.